guess we will call day 2 of the meeting to order. I
think it's,
I will
think we can bring it in.
immediately turn it over to Jeff to introduce
Yes.
our guests.
Well, I appreciate it, Madam Chair. We are, one of the things I always enjoyed that we did every so often was invite managers from outside our bubble in to share their views of the world. And I'm very pleased that we're going to be doing this today. We are going to have a total of 4 different presentations. We're going to start with 3, one from each of our global asset allocation managers, and then we're going to do a bit of a panel discussion where we want this to be very participatory. We want commissioners to ask questions and frankly challenge them. So we're going to do that, and then following that, I'm delighted that we're going to have a gentleman from Brookfield Asset Management here, and Brookfield invests across private markets. So we're going to have the first 3 are going to take us around the world of public markets, and then we're going to close out with a speaker from Brookfield regarding the private markets. So I'm going to turn it over to Steve, who hired all 3 of these firms that we're about to hear from. So Steve, if you want to do some introductions for us, that'd be great.
Sure. So I'll do them one at a time, and first will be Guy Stern from Aberdeen Standard Life. Before I hop into that, just to reiterate some of the comments that Jeff made, as a quick refresher, we approved 3 mandates to Aberdeen Standard, Morgan Stanley, as well as Pine Bridge last September. And the goal of the mandates were twofold. The first was to add excess returns to the portfolio, really through tactical asset allocation, and how we think about that is the process of selecting markets versus individual securities, and also increasing or decreasing risk depending upon the current economic conditions. Historically, this is an area that we haven't focused as much or used as much of our tracking error budget doing. So we wanted to extract that value from our partners. Second was to create an extension of staff model where we have more higher touch, more frequent dialogue and communication, as well as the ability to leverage their teams, their research capabilities, and I think, candidly, like opportunities like this to get them to come in and speak on our behalf about the portfolio, but also to help educate about where we are in the cycle. So with that said, I'd like to introduce Guy Stern. Guy is the Global Head of Multi-Asset and Macro Investing at Aberdeen Standard. He joined Aberdeen or Standard Life back in April 2008 as the head of multi-asset, and since joining, he's been responsible for the day-to-day management of the multi-asset investing team. So with that, I'd like to invite him up.
Thanks.
Thank you.
Oh, good. Thank you. Well, sorry, I'm going to make sure it does what I want it to do. Yeah, good. First, thank you very much for inviting us. I really don't get to do this very often, and I think the slides that we've prepared are much more stream of consciousness than anything else, so it's going to be sort of the opposite of slick. As Steve mentioned, I manage the team that does the multi-asset portfolios, and that includes everything from very traditional tactical asset allocation and strategic allocation types of portfolios through to slightly more sophisticated things where we're looking for alternative sources of return and benefit that don't just rely on what we might call naive allocations to the big blocks of assets like duration or credit risk or equity beta. So when I was thinking about what I'd like to talk about today, I really just put aside the standard packages of big economic data that we prepare, and I know that Steve and the rest of the team gets to see, and I thought I just might talk to you about the things that I'm thinking about in terms of the very immediate future and the longer term future. And I'm going to start with answering the first question that Steve had put forward, and that is sort of where are we in the cycle? And the unfortunate part is my answer is going to be, I don't really mind very much. I'm not sure that that's really the operative question most of the time. We have some really important questions, though, that are much more immediately in front of us. But I will say that we're not at the end of the cycle, right? I just don't know how close to the end of the cycle we are. In any case, what I think the most immediate question is, how do we deal with the end of the bull market in bonds? And again, the world's simplest chart. This is the 10-year Treasury interest rate going back to 1980. And I speculate that there are not many people in this room who know anything other than a bull market in bonds. This is what has happened. We have seen asset prices and economies bolstered by a low or falling or both interest rate environment for all of our history. Starting with when I graduated university and interest rates up at 14 and 15%, through to the low point in 2016 of just over 1.5%. What I feel definitively, though, is that that bull market in bonds is now finished. Now, I'm not going to try to predict a bear market in bonds and say that interest rates are going up by a lot, because I think there's something very different about the inflationary environment that, frankly, we don't fully understand. As a monetary economist, I'd sit here and say there's nothing about the environment that tells me anything other than when you print this much money, when you have full employment, when you have zero output gaps, you get inflation. That's what happens, except you don't. We don't seem to be getting inflation. We should talk about globalization and what it means it doesn't mean. We should talk about technology and how we might speculate technology changing our output gaps and what the equilibrium rate of inflation and of interest rates might be. But in the end, we don't really understand why we're not getting more inflation than we've got today. And we struggle with that. We struggle with an inflationary target. Central banks struggle to say, inflation, we would like to be higher. Now, that's an odd thing to think about if you were investing back in the 80s and 90s when central banks were saying, all we have to do is control inflation. I spent 14 years living in Germany. And in Germany, what all the central bank ever said was, we have to control prices. That's our primary mandate. So to be coming back now and live the past 4 and 5 years with central banks saying, we need to create inflation, is a very odd situation. I think what that's creating is a very different reaction function in asset prices right now. So what I guess I'm speculating is that how do we try to earn adequate returns, the returns that most pension funds or endowments or plan sponsors of one form or another need in order to hit their targets in an environment where interest rates are rising? And let's just, again, in very simplistic terms, define what that means. If we've got the 10-year bond in the US at 3%, and by a gross margin, the likelihood is that interest rates will be rising rather than falling. We can talk about the steepness of the yield curve, but in any case, interest rates going up rather than down from here. Over the next few years, what you're going to get in return from sovereign debt duration is the coupon or less. That's about it. So I don't see duration as a great way to earn money. And if that's not available to you, then let's select the next asset class that you might take a look at that's been really beneficial over the past 5 and 10 and even 20 years. What happens to credit? Credit's your next big block of assets, very liquid, very big. But if you're in an environment where credit spreads are also very, very narrow, not as narrow as they were in the silly seasons of 2005 and 6, admittedly, but still we're talking about investment grade credit spreads that are down in the 60 and 70 basis points. Again, interest rates low. As you approach the end of the cycle, whether we're there or not, another question, you have a very low probability of making a return that's anything more than the coupon. Credit spreads expand, interest rates go up. You have another block of assets that, at best, you're going to be able to extract 2.5 or 3% return from over the course of the next 2 and 3 years. And then the third block of assets, equity beta, you have to question again, what happens to equity prices? What am I willing to pay for earning streams, future earning streams, whatever they might be, if I don't have the support of a continuously lower discount rate? So this, I think, is a much bigger conundrum than most of the other things we're focusing on right now. Between this and the general health and welfare, the shape of the economy, that's what I think our big questions for asset allocation need to be. I just want to mention, though, one asset class that I don't think is overpriced or subject to a horrible revision right now. So again, one of the world's simplest charts. we tend to think of home prices as a great way, or real estate in general, as a great way to earn money. Everybody gets rich by owning property. And what I did very simply was say, let's take a look at home prices over the long term and see what they've actually done. And what you see is a tremendous amount, or a tremendous propensity to be over and undervalued versus the long-term trend of return. And by the way, this is just the Case-Shiller, or the S&P CoreLogic now, but Case-Shiller Home Price Index over the very long term. I took it back to where it was first calculated back in '87, and I started at the low point in 1994. Now, amazingly, or maybe not so amazingly, house price appreciation is virtually identical to nominal GDP growth. In other words, everybody who made a lot of money in houses, in their homes and in buy-to-let properties and so forth, all they really did was store value. They made exactly the same amount of money with these great big swings and roundabouts as the economy made. It's a great way to keep up with the economy. It's only a great way to earn money if you can buy at those lows and sell at those highs. Very few of us do. It's a completely cyclical asset class, but it is normally shaped. So not all of our asset prices have become subject to revision. What we know is that this isn't a mispriced asset for the general population of the United States in any case. And in the end, we can become very overvalued and very undervalued. Where we are right now, I think, is just an interesting point because you're quite literally at the tangent line. So in terms of the wealth effect that we see in the United States, we don't see a tremendous danger, but the same question arises. If you raise interest rates substantially from here, what do you want to do with this line? What do you expect this line to do? And that becomes either your opportunity or your risk. Real quickly, to answer the question of how we might be positioned in the portfolio, that question about where are we in the cycle and why I'm a little bit less concerned about whether we're 2 years from the end of the cycle or 1 year from the end of the cycle or 4 years from the end of the cycle. The fact is that in most circumstances, whether you are in the latter part of the cycle or very near the end of the cycle, risk-based assets, growth-based assets, still tend to perform really well. It's only when you are completely convinced that you are at the end of the cycle that you need to completely back out of risk-based assets. So if you take a look at our more conventional asset allocation, what you see is big allocations to public equity, allocations to real assets and real estate, a little bit of concentration on inflation, and in the end, a pretty big underweight to core duration. That's interest rates going up. That's literally to finance everything else that's going on in the economy. So as much as most of the slides here are going to be oriented towards there's a lot of danger around, at the end of the day, I think that growth assets and risk assets are where you're going to be earning money for the next 1 and 2 years. And allocating between them carefully with some strategies that can help dampen the volatility is where you want to be. I want to talk just very quickly about a subject that comes out from time to time about global trade and trade barriers. I think this has gone missed as, again, one of the supports for low interest rates. I guess my tagline would be, globalization has been very good for the global economy. The problem is it just can't help you very much anymore. Stepping back in time, we've just looked at the global trade barriers as a percentage of total trade going back into the 40s and 50s, and how trade barriers have fallen from somewhere in the neighborhood of 14% down to more like 4% now. If we're going into a period of trade war, there's lots of talk about that right now. We know that there's just been some tariffs signed on all sides of the Atlantic and Pacific. The problem here is that we don't have the advent of cheaper global trade supporting economies and supporting low inflation anymore. What we don't know is how much this is going to rise. That's been matched by deregulation internally. If you take a look at most developed countries, what you've seen is that there's been a deregulatory movement over time. In other words, making the environment cheaper to operate in, again, a deflationary phenomenon that's going to be hard to replicate going forward. Those disinflationary forces become more difficult to produce, resulting in globalization that has largely taken place. When you take a look at where manufacturing has migrated to and the growth of manufacturing in various areas, you see where it's gone. It's gone to the developing markets and the underdeveloped markets. How much further this can go, I have a hard time projecting, but my point is we've been there already. We've visited globalization. We think it's generally been very good for trade, very good for the economy. It's not going away. It's probably not reversing, but it can't help very much anymore. You notice I'm running through these a little bit quicker because I can tell I'm running out of time. Just a couple more slides. Where is the danger? If we take a look at the corporate profit share in the economy, I won't say we're at peaks, but we are at very, very high levels. Margins are high. The corporate profit share is very high. And you could turn around and say, yeah, but that's not accruing to the market capitalization. That dark line is the S&P market capitalization, approximately 8% below where it was in the peak just before the tech wreck. What this hides, though, is the fact that there's been a de-equitization. Buybacks, takeovers, mergers, and so forth, that has largely promoted the EPS growth that we're all very familiar with at being in double digits for decades at this point. Let's remember that the return of the S&P, the price return of the S&P, is about 80% from that previous peak in 2000. And the total return of the S&P is about 160% since that peak in 2000. So we've had a de-equitization, but a tremendous level of total return from equities. That, to me, represents a vulnerability if you cannot maintain that blue line at these levels. Last couple of points have to do with what has the effect been on the human component of the real economy. And I'm going to take this in a slightly different direction. This takes a look at the hollowing out of the middle class. What we've seen is that the rich get richer and the poor get poorer, and it's not just happening in the US, but it's happened virtually everywhere, certainly in the Western developed world. And if we take it a step further, we can see that, again, it's the top margin of earners that have captured most of that increase in income. The issue that I have with this inequality of income statement that's being made is that I'm not sure if it was ever so. In every global expansion, is it the case that the top 1% and the top 10% actually accrue almost all of the excess income? And this also doesn't account for the spreading of wealth in emerging markets and specifically in Asia. So I think when we start to take a look at these statistics, one of the things that are missed is that on a Western world income distribution, the top earners have accrued all of the income, but that might not be different than any other global expansion. And secondly, it completely ignores the fact that on a global scale, a huge cohort of emerging markets have gained a much larger percentage of total global income. So the income inequality question is real, but it may not be different than it's ever been in the past. So very lastly, where do we sit now in a global cyclical environment? And interestingly, what we can see is that we're not very different in terms of the shape of the economy than we were before the global, not really so global, but the global financial crisis. We suffered a step change in 2008 and 2009, and then resumed our global growth path. So where are we in the cycle? Certainly past the middle. If you accept, however, that the cycle could be faster and slower growth rather than growth turning into recession. Are we right at the precipice? No, I don't think so, but I don't mind very much either way. You still want to be invested in growth assets well towards the end of the global cycle. You only want to back away from them when you're convinced that the interest rate environment produces a recession, and then you back away. Hope that helps.
Thank you. See who we have next here. All right. Yep, there you go. Great, thank you, Guy. So next we have Michael Kelly, who's the head of global head of multi-asset at PineBridge Investments. Mike joined the firm in 1999 and is responsible for overseeing the firm's global multi-asset business. He founded the firm's multi-asset investment process and integrated several formerly independent regional teams into one global team focused on total return orientation, specifically asset allocation. Prior to joining, he spent 15 years at various equity research firms, as well as working in an economic consulting firm, Townsend Greenspan. Without further ado, I'd like to invite Mike Kelly up to share his remarks.
Okay. To every speaker, we're always a little nervous until that button moves the yes. Okay, I've relaxed completely. Thank you very much for inviting us down. You know, I think all of us actually enjoy these types of things. It's a little unusual. You get competitors in the room to share kind of their strategy. But we all learn from each other, and it's all about helping you do better. And so I hope we hear some different views on where we are. We are starting by the script, and then after about 5 minutes I'll go off script. But where are we in the cycle? Doesn't matter. We've been very loud saying, really, it's not very late in the game. A guy just said something similar. We say it a little bit more definitively. We actually do think it matters a lot. Are you early, mid, late? Because it shifts at least how we think of where to invest and how. And I'll tell you why we think it's mid-cycle, not late cycle. And I'll tell you why we think you're hearing from most people, why it's very late in the game. Be careful, be cautious. So, you know, there's hundreds of things you really should look at. If I had to give you just one, that's the most indicative. It's called a global output gap. It's to the left. It's sort of the supply and demand for stuff all over the world. And this little dotted line tends to be, I don't want to say overly reliable. You have to confirm it with a number of things, but it's something we've looked at for a very, very long time. So this 2003, that's classic early cycle, lots of slack. This is 2007. Now, I'm going to sound optimistic later on, and just so I'm not labeled in your head a perma-bull or anything, we were actually very, very cataclysmic in 2007 before the crisis broke out. One of the big reasons was we thought, indeed, it was late cycle. What does that mean when you have very little slack in the economy? Well, it means it's tough for the economy to grow. It means profits really struggle to keep up. Profit growth slows relative to GDP growth. Very little potential to grow. And on the next page or two, you're going to see the risks related to that cash flow were skyrocketing at the same time. Now, you know, here, I mean, if you had to look at just one thing, and people are saying it's late, I'd say, well, you know, prove it to me, because it looks decidedly mid to us. Other things you look at are how do profits grow relative to sales, how do profits grow relative to GDP. So, you know, when you're early, profits are really rising at a very rapid clip relative to incremental growth, incremental sales. They're still very healthy in the mid-cycle. They slow down a lot. So you look at a lot of things to confirm. The December profits were amazing. March profits were amazing. Very mid-cycle, not late cycle kind of behavior. What do you call this? This is not classic early, classic late. This is a once in 70 year, very, very deep hole called the financial crisis. We crawled out of this very, very, very deep hole very, very, very slowly. And the next couple of pages will be, why did we crawl out of it so slowly? So yes, for those who are very concerned it's late, most of the reason is it's been 9 years. You know, and the average cycle lasts less than 9 years, and therefore, tell that to Australia. They're on their 26th year of expansion. You know, many say, you know, it's not the length of time, but the amount of wear and tear you put on the system. But we haven't put on a lot of wear and tear. The other reason you worry about sort of late is that inflation flares when you get here. But there's another way of looking at inflation too, kind of gets to what Guy was talking about earlier. This is inflation in different countries around the world. And look how disparate it used to be and how similar it is today. That's kind of a huge message that today, more than any time we've ever seen, it's the global slack that matters. Because the late cycle people will also say, you know, the labor force in the United States is tight, therefore game over. A regional bottleneck is tight, therefore game over. This is saying the game is now global. Of course, because we trade more freely, we're big believers that we're in a period of trade tension and trade dialogue that actually is going to have a constructive ending. We think there's going to be more trade a year, 2, 3 years later from now than less trade. And we can get to that also. But decidedly mid-cycle in our view. Why did we crawl out of a very, very deep hole very, very, very slowly? You know, a lot of people have been talking about how slow the world has been since the crisis. And there are two big camps. There are the secular stagnators. You know, we're all getting older, debt's very high. You know, we're going to grow a very slow period for a very long time. There are also the post-crisis, you know, Reinhart Rogoff types that said, you know, before every crisis ever, you have a period of very rapid leverage growth. Leverage pulls forward consumption, pulls forward investment, speeds things up. During every single crisis ever, you have a period of about 10 years post-crisis deleveraging, during which growth is slow. For a while, we didn't know which was the case, and it didn't matter because both paths pointed in the same direction. But we have inflected upward. If you keep interest rates low long enough, or even negative, you'll recreate leverage for sure. But this meant the slow motion world that we were in is gradually accelerating. And we're going to characterize that acceleration soon. But first, one last thing. This is a global savings rate in green. The black is the size of central bank balance sheets versus the size of the nominal economy. The black should be flat. If it's flat, central banks are neither adding liquidity or taking it out. But let's look at the green for a minute. This is before the crisis. The global savings rate around the world popped up before the crisis. Ben Bernanke labeled it a global savings glut. I remember thinking back, interesting, I've never heard that term before. You know, but he was saying that while we're used to savings rates declining into a recovery, people get more confident, they spend more, they invest more, they get more confident. Global savings rates normally decline into a recovery. Bernanke said, now remember, well, it's hard to remember because they only come around once every 70 years, but after a good financial crisis, savings rates actually go up into an expansion because people look over their shoulders and never going to let that happen again. And what this was all about, this was about the echo of the Asian financial crisis. And when they got back up on their feet, Asia materially boosted their savings rate, and it caused a global savings glut. Now we've seen the same thing. The rest of the world materially boosts its savings rate after the crisis. This is the same old, you just don't know it. They only occur once every 70 years. What does it mean? Today we have twin liquidity gluts. We have a naturally formed liquidity glut. It's going to take 5 to 7 years to go away. We also have a central bank liquidity glut. It's going to take 5 to 7 years to go away. Now, you know, noise signal, it's really hard in our world to stay focused on the signal because there is so much noise. We think at the end of the day, investing is always about the cash flows and how you discount the cash flows. I just showed you because the deleveraging is behind, the growth of the cash flows is now accelerating. Remember what Guy said, it's too early to get out of growth assets. The growth, particularly of growth assets, of cash flows is accelerating. The discount rates are going to have a very hard time. They're going to creep up, but they're not going to be able to keep up with the speed with which cash flows around the world are rising. Throw that through your DCF in your head. That's a very, very optimistic world. Now, this is something our PineBridge team has done for about 17 years. It's a 5-year forward look on return prospects, vertical, risk, horizontal. It's called the capital market line. And for us, it's been a very useful tool. This was pre-crisis, June 2007, remember? Output gap, there was no room for the economy to grow, no room for cash flows to grow. Remember the leverage, the risk underneath those cash flows was sky high? Today, there's plenty of slack if we trade freely. Today, the leverage is much lower. Today, the biggest problem is the weight of all that money. It's weighing down prospective returns. Prospective returns are going to be lower. That's what happens when you have too much money chasing too little cash flow. That's the bad news. The good news is the dispersion of different kind of asset classes, in our view, is going to be exceedingly wide looking forward. As we reaccelerate, as we reflate confidence, we reflate growth, some growth assets are really going to catch a tailwind, and their cash flows are going to rise especially large. Think of this twin savings glut, twin liquidity glut as a loss curve that you have 5 to 7 years to outrun. So you have to be in asset classes whose growth can go up more than that loss curve coming down takes away from you. One other way to think of the period we're in is that it's not necessarily just about a cycle. This is our way of thinking about cycles. We call it balanced growth, not because it's balanced, but cycles can self-adjust. Give it 2 or 3 years, if something overheated, it can self-adjust. There are also periods we call regimes. Regimes are periods of persistent imbalances. They'll eventually adjust. It could take 2 or 3 cycles to adjust. You bring China into the global trading system in 2001, 1 billion people into the global labor force. That's going to take you more than 1 cycle to get used to. These things called regimes. We are of the view that when we were deleveraging and many other post-crisis headwinds were depressing activity, we were in a stall speed. We've seen it many times over the last 100 years in different places at different times. It does shape the cash flows that come off asset classes, makes them slow. It does shape the cash flows, and they become also more homogeneous as well as slow. The risks related to those cash flows go up because you're growing at such a treacherously slow speed that any shock can send you back into negative territory, and it changes everything. It's a regime. It changes which assets win or lose, how they play nicely or not nicely together. We have shifted, we're going to assert, into a reflation regime. Reflation is not inflation. Inflation is unhealthy imbalance, too much demand for stuff, too little supply of stuff, too much demand for liquidity, too little supply of liquidity. Stall speed's exactly the opposite. Reflation is a journey to balance. And we've seen reflation many times in many places. This is actually a tell. How do you know when you've regime shifted? Well, there are patterns in the market between asset classes. We call them correlation footprints. This is risk to risk. Risk to risk asset, risk to risk asset sold on their own individual opportunities and individual risks. Come a crisis, they all of a sudden had a shared anxiety of the future during stall speed. Middle 2016, private sector deleveraging ends. A lot of other post-crisis headwinds end, and we have shifted into a different relationship of asset classes around the world. What happens historically when we come out of stall speed, out of these depressing periods where growth is so slow, there's a shared anxiety about the future? When you come out of that, the first thing that pop is confidence. Business confidence, consumer confidence. This is how we get rid of global savings gluts. People start spending more and growth picks up. They start investing more and growth picks up and cash flows pick up. And it's all playing to the script, except for one thing. This is going to be a very different reflationary period, we think. We're labeling it a very disruptive reflationary period because at the same time, there's actually key things happening, and they're happening on the technology side. On the technology side, there are many people that are saying we're in the fourth industrial revolution. And so let's learn a couple lessons for the first, second, and third industrial revolution. What happens when you're in the first, second, and third industrial? You end up having very elongated cycles. Growth accelerates. Inflation is missing in action because productivity comes out of nowhere from the causes of these industrial revolutions, and they're all technology related. We've been in a period, this is a CIO survey, where every year you survey CIOs saying, you're going to do anything this year? You're going to invest any more money? And they've been saying, no, 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 no. Our analysts, when we've been asking them, when are your companies going to start? They've been tremendously underinvesting since the crisis. When are they going to start investing in their business the way they used to? And until about 18 months ago, most of our analysts, whether private equity, private credit, listed equity, would say they're not. They're just not. That's all changed. The attitude has moved away from financial engineering to saying we have to stop ignoring our basic business and start investing again. But this is the first time I've ever seen where when you ask them, what are you going to invest in? They do not use the capacity answer. They use the capability answer. So they say, you know, we're seeing more and more of our neighboring industries being disrupted by new technologies. We're going to arm ourselves with those same disruptive technologies and rebuild our business moat before someone attacks us. You know, you don't get a lot of productivity in an investment cycle when you add the 10th generation of a machine and you already have the 8th in place. That's 2/3, 3/4 of every cycle. You're putting in old stuff, but more of it. You get real bursts of productivity from a lot of new stuff. And this cycle is going to be a huge mix of new enabling technologies. That's what all of our surveys are saying. And again, that's the good news. We're going back to the first, second, third industrial revolutions. They all involve some basic enabling technology that was created 30 years prior and grew like a weed, but it didn't hit critical mass and change where things were made, where things were distributed. You didn't see big industries rise and fall, generally until about 30 years later. Now, Greenspan, in the mid to late 90s, he was approaching a moment of time like this. And he stopped, he paused. He didn't go through what is called neutral Fed policy. The kind of interest rates Guy was talking about threaten an economy. He didn't go through that, because he saw what people were talking about was the new internet economy. He saw it right in front of his eyes. He said, we're going to get a productivity miracle. He forgot about the 30-year thing. Forgot about the 30-year thing. How much did email addresses and websites change the world? Not much. 30 years later, today, AI was born 30 years ago. And yes, that's the one, that's the game changer. That's what crept very slowly ahead for 28 years, but in the last 2 years is taking off, and with it powering up big data, powering up robotics, powering up the Internet of Things. That's the fourth industrial revolution. That is very, very disruptive. There are big implications of this. This was kind of a mini, this is a late 90s mini, you know, websites, emails, how much does it change the world? But when you go through even minis, you have a period where patents are filed. This is a very special study that takes patents and dissects them into minor, trivial, you know, if you have a drug and it's, you're making a very minor modification of a drug. You may get a patent, but that's very different than a landmark patent. This is actually looking at landmark patents. The first, second, and third industrial, you had landmark technologies, and what they're accompanied with in a period of accelerating growth is also accelerating bankruptcy and accelerating default into accelerating growth. So disruption is something we haven't seen in a very long time. I'm a little running late, sorry. I'm going to give you a couple musts think about at least in a disruptive world. You know, when you're in a post-crisis period and leaders, like everybody else, are not investing very aggressively in their business, what do you call that? We call that a competitive timeout. If you're a laggard, you just sit back, you pay off debt, you refinance things. Cash flows during the stall speed became slower but more homogeneous. That was a wonderful world with homogeneous growth of cash flows within industries to just index, because there wasn't a lot of differentiation to pick up on. What do you call a very disruptive period when laggards don't just lag, they start going out of business? You call an index fund a very expensive product in that world. And we think that's going to happen. You know, when the Model T came out, buggy whip businesses were still thought of as highly profitable, highly stable, highly cash flow generative business. Handful of years later, they're out of business. You must be active when you go into a disruptive period. We also think that that implies, on the margin, you want to be a little bit more liquid as you go into a disruptive period, because it's very, very hard to spot where the unicorns will be. It's very, very hard to spot where the roadkill will be. But if you're liquid, you can sell that roadkill down 30%. If you're private, and you haven't properly future-proofed every private investment, you could ride that to zero. So the sweet spot, we believe, for passive is behind. You have to be very liquid. We always look at what most people are doing and say, is that wise for the environment ahead? Most people today are getting out of active equity. They're getting into passive equity to be able to afford more and more private investments. We're questioning sort of the wisdom of that going into such a disruptive period. We're not saying don't go into private investments, just slow down, make sure they're future-proofed. We think that we're also in a world where financials and productivity will be sort of the better two sectors in this world of stepped-up investment. Own the disruptors, the sellers of the disruptive technology. Unlike unicorns and roadkill, they're easy to identify. Own the financiers of stepped up. So reflation is good at a macro level, but at a micro level, it's very challenging. You have to be very high active share. Anyway, that is our take on the world ahead. I look forward to the panel and your questions later.
Thank you, Mike. And last up, but not least, we have Mark Bravozo from Morgan Stanley Investment Management. He joined Morgan Stanley in 1986 and has been with the firm for 35 years. Previously, Senior Vice President and Portfolio Manager at Dean Witter Intercapital and Vice President in Equity Marketing and Research Departments. With that, there's other stuff on here, but I'm anxious to get him speaking on his presentation. So,
Thanks,
Mark
Steve.
Bravozo.
Thank you. Thanks. All right. So batting cleanup. First of all, thank you so much for the invitation to come and speak to you a bit about our team's views on the markets and the economy. And I think in Steve's wisdom, actually, the order of the presentations probably makes sense. We're going to get down into the weeds a bit with the data. If you have any questions on any of the either conclusions or data points that we include in the deck, please bring them up during the Q&A session, because I'm going to go through this material relatively quickly in light of the time constraint. But I did want to at least be able to give you some sense as to where not only we're positioned, but also some thoughts relative to the question on the cycle, because as the previous speakers pointed out, determining where you are in the cycle is extremely difficult to do, but having some sense as to where the cycle is going is absolutely critical in terms of positioning the portfolio. And so we'd like to spend a couple of minutes on that topic as well. So generally speaking, just to provide you with our conclusions at the top, global growth has surprised us this year, U.S. growth especially going into the back half of this year. It's not inconceivable that we'll print 4% GDP growth in the second quarter, up from about 2.3% in the first quarter. So the U.S. is still caught up in this fiscal spending euphoria that's worked its way through mostly consumption, not so much on the industrial spending and CapEx side yet. The statistics related to IT spending, I think, are evidence of that 10 years into a U.S. recovery, we have IT spending up, just 5.5%. Typically, at this stage of a cycle, CapEx, including IT spending, should be well in excess of 8%.
Can I ask maybe a little technical question there? How much does software as a service versus software as a purchase influence that number, though? Right? Because software as a service, your budget year to year is, basically incremental, whereas in the past you'd have to do a big upgrade cycle periodically, so you'd see more spiking behavior versus consistency.
Yeah, I think the annuitization of that budget over time for most corporations has affected sort of the lumpiness or the cyclicality of software. Hardware basically goes back to the core of the server, so it's not even as cyclical as it used to be. So what you're actually seeing is, in my view, and others can certainly chime in, but what you're actually seeing in that cycle is the absolutely necessary and required spending that's going into CapEx that has to be done in that given year, which in a way is, I think, is being as measured as different areas of capital spending in the economy generally. Corporations simply aren't throwing money at long-term investment opportunities for returns as they would typically this late in a cycle because those returns aren't visible to them. So they're being much more conservative, whether it's the annuitized stream of CapEx or the cyclical side. In my view, I'm sure the other speakers can address it during the Q&A. Do I get that time back, or is that? Yes, penalty time, thank you. So U.S. strong, pretty much in our expectation, sustainable right through the balance of this year. The headwinds start, we believe, in 2019 when we begin to lap some of the great and out of consensus improvements we've seen this year. Fed's on track to hike, as you heard in yesterday's testimony and press conference. We do think it's important to keep in mind that the Fed plan to raise interest rates in the balance of 18, 19, and into 20 is well in excess of what the market is pricing in. So that distinction or differentiation between what the Fed is telling us and what the market believes is going to happen is absolutely material in this environment and actually gets to guys' slide on the long-term pattern of interest rates, and one of the reasons why we've seen long rates stay a little bit more measured in this environment, because the market as yet doesn't believe what the Fed is prophesizing. Right now, it looks like China continues to stay relatively stable. This is an area of the world where we're focused primarily on the headwinds that are developing, and I'd like to spend a little bit of time there because it does influence our portfolio positioning to a great extent. Emerging markets, excluding China, have recently been hit by the mini tantrum associated with the stronger dollar, as well as political turbulence around the world. We think that's probably run its course for the time being. There are, interestingly enough, even this late in the cycle globally, very few excesses that have built up in emerging markets, as we would typically see, and that's actually, we believe, created an environment where emerging markets could come through this cycle in better shape than they typically do in a late cycle environment. Real conundrum is the weakness in the Eurozone, which we've been much more optimistic on coming into 2018, and we simply haven't seen the growth recovery. Even with how strong the world has been, Europe simply can't pop out of a 2.1%, 2.2% GDP growth rate. We're basically on the fence in terms of whether that acceleration comes, but if pressed, we'd be a little bit more biased to expecting positive surprises out of the Eurozone going forward, only because of the world picking up the region itself. And then finally, tepid inflation readings continue pretty much throughout the world, and interestingly enough, including in emerging markets. But we do believe global inflation is bottoming. We're seeing it earliest in the countries that are responding soonest to pulling monetary accommodation. So obviously in the U.S., but we're also seeing slightly higher inflation than was expected in the U.K., for example. And evidently, Mario Draghi sees it in Europe as well. No one else in the world does, but it must be coming if they say it is. So the debate on inflation's rise and the acceleration of inflation, I think, is valid. The debate on the directionality and the change in inflection, I think, is pretty clear. In terms of portfolio positioning, we do have some slides at the back. If we don't get to it, I'll just mention that right now we are equal weight global equities, kind of balancing out the fact that there isn't a real valuation call in global equities generally as an asset class, but there are regionally in our view. So we are underweight both U.S. equities and China equities in EM, and overweight Europe and Japan and some select EM countries as well within that mix. In terms of bonds, generally concur with the views expressed earlier on investment-grade credit and high-yield credit. We're equal weight both those asset classes. We are somewhat concerned about the challenges that corporations face going forward, especially with as tight as spreads have been in both those markets. You have to consider companies today are facing the prospects of much lower free cash flow growth expectations in the next 5 years than in the previous 5 years, higher wages, higher input costs, and higher interest rates generally. So the model for most U.S. corporations that have been flush with cash, buying back their own stock, making discretionary contributions to pension plans, et cetera, is become a much more challenging response in terms of how they're using the depleted levels of free cash flow to fund their required expenditures. And we think ultimately that works its way through interest expense coverage and begins to impair the value of both investment grade and high yield bonds. But this, again, acknowledging what we're seeing in the market, is a very slow moving cycle. And we believe still merits having equal weights in both IG and high yield. We are slightly overweight U.S. governments. We believe the 10-year over 3% is an interesting value, even in an environment where inflation is rising. We think that the inflation rate is basically going to settle somewhere in the low twos as we move forward, and that the long end of the U.S. bond curve is pricing in a further acceleration. So that provides a little bit of an opportunity. And then finally, we're overweight tips in the portfolio as well. So with that as a summary, what I'd like to do is just go through some charts and give you some data to chew on. I will go through these relatively quickly, as I mentioned, but again, I want to kind of bring this down into the more anecdotal side, just to give you some sense to what we're looking at. We do a great deal of analysis on purchasing managers' indices surveys. They come out monthly. They tend to come out early. They're the first series of economic data we get that look at the forward expectations for growth. And in general, they give us a bit of a window and correlate relatively well to GDP. We do customize these indices to kind of get a higher degree of predictability out of them. But generally speaking, right now, global growth based on the PMI All Industry Index is expected to hit about 3.4%. It has come down a bit from its peak, but that's still a relatively heady number considering how late we are in the cycle globally. One of the elements of leading factors that we look at is money supply. And while it's not terribly predictive on a tactical basis, strategically or over the long term, it does tend to lead industrial production, industrial activity. The blue line in this case is money supply, which you see has declined in terms of its year-over-year growth rate materially. The black line is industrial production, which has climbed very, very sharply, obviously in the more recent recovery, say 3-4 years. But the expectation here is that we're facing the inflection point for industrial production as well, if it in fact continues to correlate with M1. In terms of the global economic cycle, I wanted to spend a moment on this slide because it's come up a couple of times, and again, acknowledging the fact that this is a very difficult period, as most are, to calculate precisely. We do think that the U.S. is much later in its cycle than we believe the consensus believes, and we also think the risk is relatively high of overstaying your welcome in this environment, simply because all of the historical expectations and markers that we would look at to indicate overheating have been compressed dramatically. So we've recovered at a slower rate. We came into the recovery with a much higher level of slack, as was mentioned earlier, and we've had a very muted and delayed response to beginning to respond to that recovery. So, 5%, 6% inflation isn't what we should be talking about. 3.5%, 4% inflation will probably be enough to signal that this cycle is not only over, but that the Fed has done its job and begun to restrict growth. So we do believe in this case that the U.S. is very much in a late cycle environment. As you can see, I don't know, yeah, there we go, here currently, and then just tipping over into the overheating phase as we go into 2019. Number of economies elsewhere in the world still basically in mid-cycle. And then interestingly enough, the performance of assets in each of these phases, expansion, overheating, where we basically are now, very good for global equities, okay for bonds, good for commodities, and then obviously when we get into the true overheating, the Fed response takes hold. You can see that the risk is very high of overstaying your welcome. Global equities tend to generate large negative returns in the early stage of that cycle. Bonds tend to have material losses, and commodities up 8% in the historical data tend to be your inflation hedge and your winner in that environment. This is data we've calculated since 1962 to present to get the results on each of these cycles. So again, very difficult to judge where you are in the cycle, but important, we believe, to have a view as the risk of overstaying can be dramatic for portfolios. Let me move forward on wages. In terms of inflation and wages, this has been a significant disconnect in terms of those that follow the Phillips curve. We should have inflected to higher wage growth levels already. We've not seen it, but we do believe here in current environment, we're likely on the cusp of beginning to see inflation, wages accelerate, currently growing somewhere in the neighborhood of 2.8%. And you can see in terms of average hourly earnings data, this has been relatively flat for a material period of time. To Guy's point, not exactly a statistic that would point to late cycle overheating. But the employment cost index has shown a little bit of a different picture. This comes out quarterly. We believe the next data reading here will have wage growth over 3%. Wages in the U.S., in very general terms, tend to grow negative during recessions, say plus 3% year over year on average, and well over plus 4 or 5% during an overheating environment. The interesting thing about wages is they never grow at 3%. They're either at 3% on the way down or at 3% on the way up. And so when you begin to kind of cross that threshold, it tends to signal either an acceleration or a deceleration. And again, we believe we're right on the cusp of that now. The most recent inflation data out of the U.S., 2.2% on the May CPI that was released this week, implies the core PCE at 1.9% in its next release. And the core PCE is what the Fed focuses on in terms of its inflation reading. So for all intents and purposes, we've hit the Fed's target in this environment. This is what I was speaking to earlier in terms of the Federal Open Market Committee's dot projections. This chart basically shows you where the dots were during the previous meeting and where the Fed has moved their expectation for rate increases as of this week's meeting. And you can see that they've taken a bit more aggressive stance, now expecting a total of 4 rate hikes in 2018, so 2 more by year end, and then 4 in 18 and 19. Basically, this gets us to 2.5% funds rate by the end of this year and 3.5% at the early part of 2019. Quite a headwind for an economy that's only just begun to kind of get its sea legs under it. The concept of the importance, as a couple people have mentioned, related to, or previous speakers have mentioned, related to the end of free money and the importance of the accommodation being pulled, is I think best characterized in what we've seen from QE and monetary accommodation in the U.S. affecting asset valuations. The blue line here is the combined value of U.S. stocks, credit, and residential housing. The black line is the Fed funds rate going back to 1950. And you can clearly see that when the Fed is accommodative, it has a material and exaggerated impact on the valuation of hard assets. This was the peak. This is basically where we are now. Even where we are now, after we've come off the peak valuation, is still a record high total valuation for these 3 assets in combination. Again, the point being the risk of overstaying your welcome in this environment, very late cycle U.S., and a reacceleration around the world is high when these trends begin to reverse. I'd like to spend a moment on the Eurozone, a question that Steve's staff brings up constantly because we do have a bullish position on Eurozone stocks, which has not exactly served us terribly well this year. The question comes up in terms of what we see or what we look for some optimism out of Europe, which has been relatively disappointing. The trend in retail sales is to the up, sort of the northeast. It's generally good to see, and we have seen actually anecdotal retail sales out of Germany and France picking up more recently. Wages in Europe, interestingly enough, have actually gotten up to about a 2% level. This is a material improvement in an economy that's driven much more by unions across the board, and to see union concessions being given for higher wage growth, we think is a sign of optimism and actually a positive sign for future growth of the economy. And then finally, passenger car registrations, the equivalent of sales, are growing at about a 9% year-over-year rate in Europe and showing some signs of improvement as well. So we're, again, still on the fence on this trade and this view, but at the margin, we still feel relatively comfortable that Eurozone is going to come back with slightly better growth than expected. Couple of charts on China, and then I'll conclude here in the interest of time. We have, for some time, been analyzing a great deal of data out of the China market. As you're all probably well aware, Chinese GDP growth, 6.5% for the last 6 quarters on average, has held in relatively stably as Chinese authorities have been effectively balancing their concern with deleveraging the economy at the margin and not tanking growth. And to their credit, they've done a good job at striking that balance. But more recently, what we're seeing is in terms of nominal GDP growth, which is material for Chinese equity investors, we have seen deterioration. All 3 of these charts are various indicators relative to nominal GDP growth. Top right is money supply. Nominal GDP growth right now in China is about 10%. It's down from about 14-15% at its peak. Money supply has dropped materially, as you can see. TSF credit impulse, total social financing, is the lifeblood of the Chinese economy. It's basically the capital that the government places into the economy to keep it growing and keep it financed. The last 3 phases of Chinese cyclical growth were fueled by dramatic increases in total social financing at the government level. This feeds into infrastructure investment and capital investment in general. And each of these 3 last cycles has resulted in less payback in terms of GDP growth, with the most recent cycle, and this is a pretty material stimulus in 15-16, resulting in simply keeping GDP flat. So without that stimulus in the economy, it's likely real GDP would be growing somewhere in the 4 to 4.5% rate, just to give you some sense of perspective. Right now, this TSF indicator implies a considerable drop in nominal GDP growth going forward, and is a concern that we have. And then finally, industrial profits in China tend to be driven by nominal GDP growth to a much greater extent than most DM economies. It's calculated that Chinese industrials need somewhere in the neighborhood of 8% nominal GDP growth just to stay profitable. That number in the U.S. is probably something closer to 4%, as it is in most developed market economies. So right now, we do expect that this drop-off in nominal GDP growth is going to have a material impact on Chinese earnings, which feed back into expected valuations for Chinese H shares. And in that case, we are underweight the H share market in China, which tends to be the older industrial companies in China, not sort of new tech. Again, I mentioned our portfolio positioning just to give you an idea. And summary slide can kind of walk you through our thoughts on that. Some of the upside risks obviously are clear from the earlier presentations. We do have an environment where the U.S. Has surprised on the upside and has shown some sustainability, although we do question the commitment of U.S. corporations in terms of overall capital expenditure intentions, which are still quite conservative. You also don't see kind of capacity utilization picking up in the economy as well, and other signs of true overheating building yet. But to us, that's more of a sign that we're so late in the cycle that probably won't come through in this late stage. Fed focuses on inflation. If in fact we begin to see some concern about cresting above 2%, it is possible, although we don't believe likely, that the Fed could pull back from their tightening expectations. One sort of sense to keep in mind that does run somewhat contrary to our view is what has been built into expectations. If investors are now accepting, although the markets aren't, if investors are expecting, in fact, what the Fed dots have indicated at this week's meeting, there can't be much more expectation that they can be more aggressive. So in a way, investors may be sensing that the worst-case scenario is already laid out before us by the Fed, as opposed to, say, the ECB, where the announcement of pulling back QE was made with such a dovish tone that it almost appears that the risk with the ECB in Europe is that the policy is overstating its welcome, and that in fact the positive or the surprise may be that they need to raise rates more dramatically because they're understating the expectation for growth recovering. So in each of those cases, the environment looks relatively bleak for Eurozone relative to the US, but what expectations are built into those markets may imply that the investment in the Eurozone may be the better value right now than the US, just based on the very low level of expectation. So with that, I'll conclude my comments relative to the time that we have, and then we can discuss more of these issues during the Q&A. Thank you. Thanks, Steve.
You want to take like a 2-minute break to get everything set up? Yep.
Discussion, we wanted to make sure that we afforded some time for some interaction with our speakers. And Steve, I know you have some questions that you'd like to ask as well, but why don't you start us off, and then we can open it up for whoever has questions.
Great, so I think a lot of the questions that I had got covered throughout the presentation, so what I might do is go a little deeper into the list here, but the first question is kind of speaking to maybe active versus passive and also liquidity within the portfolio. So on the liquidity front, we've seen cash rates increase to now, if you're looking at 3-month LIBOR, 230 basis points. So how are you guys thinking about cash as an asset class within the portfolio versus maybe 2 years ago?
Well, happy to start. I mean, we haven't made a strategic decision to hold more cash relative to expected returns going forward, although the cash that we do hold, especially for collateral and margin purposes, is obviously earning a higher rate, so it doesn't have to be reinvested as quick as a pace as we have in the past. I think the issue more pertinent to our strategy as it relates to liquidity in general is liquidity of the underlying assets, and the importance in this environment especially of having a portfolio that can be transacted and turned over relatively efficiently in the marketplace. So a number of ideas that may crop up for investment that seem like great opportunities tend to be less liquid, say Greek bonds, for example, which are very attractive on a real return basis and relative to the macros in Greece. But the fact that you can't exit those positions within a reasonable amount of time relative to the rest of the portfolio factors into our portfolio decision-making now more than it has in the past. We also actively implement using stop losses, and again, you want to have a stop loss strategy that you can implement when you need to, otherwise it's not a stop loss strategy. So liquidity in this environment, we believe is paramount, and we're focused much more on it than we have been in the past.
Maybe spinning this a different way for Guy. You have a negative outlook on duration, so when you think about portfolio construction, being underweight duration, how do you think about like your safety asset or balancing risk across the portfolio when you do have more of a overweight position to risk assets?
I think under normal circumstances, that would be the balancing factor. The thing to remember, though, is that over the long term, equities and bonds are actually positively correlated rather than negatively correlated. So this idea, we got used to this idea that every time equities sold off, you'd make a bit of money on your long duration assets, and it wouldn't be too painful to hold long duration assets when equities are rallying. But that's a very short-term view. Over the longer term, again, they're positively correlated. You lose money on equities and bonds at the same time. So I don't see duration as a very good defensive asset right now. About the only really defensive asset is cash, but it's probably the worst returning asset. So let's just think about duration for a minute. We're short duration-based assets in general, mostly to finance other positions that we think are going to earn a lot more money. And that's even including the fact that it's actually very hard to lose on an absolute basis, to lose money holding duration. I mean, interest rates have to go up by quite a lot in a relatively short period of time to overcome the carry. So in the end, if you're short duration, it's not because you think you're going to lose a lot of money. It's usually because you have a better opportunity elsewhere, and that's our sense as well. Probably the worst returning asset class is cash, so we hold as little as possible, and we don't feel, based on our view of how we think risk assets will perform in the short term, we're not trying to be horribly defensive with the portfolio. You want some balancing characteristics, so we hold some tips as a duration proxy rather than nominal bonds. But in the end, we're taking a relatively aggressive stance with our portfolio. We're trying to capture return. We try not to use the words of one of our strategists, we're trying not to look around too many corners. The general state of the economy on a global scale and on a US scale is healthy. We want to capture some of that, and we want to monitor when all of it runs out of steam, cash flow, earnings, economic steam, and then you take your risk assets down.
I'll open up to any commissioners with any questions before I keep going.
What do you think the best way to measure,
Well, obviously, we're in a period of rising interest rates, but what do you think the best way to measure what should be the projected or thoughtful yield, say, on the 10-year Treasury? You haven't traditionally, people have looked at the inflation rate plus GDP rate. If you did that, obviously, we would have a substantially higher 10-year Treasury, but does that make sense?
I think it makes, from my point of view, it generally makes sense. I mean, being painfully simplistic about it, if you assume that the real interest rate ought to be somewhere around 2%, and you assume that the long-term inflation rate ought to be around 2%, 4% is where the 10-year bond ought to reside. We can wrap lots of analysis around it, lots of numbers around it, but at the end of the day, you won't come up with a very, very different number. Understanding that you're almost never going to be at that equilibrium level. You're going to be above it or below it. So I don't think we've reached the equilibrium long-term rate, the 10-year rate. I think we're still well below it, which is why I want to be short duration. I think we can overshoot that substantially, as you do in most parts of the cycle. So it's not a great place to be invested right now.
And one other question I have is that in almost every downturn in the economy or problems in the economy, very often it emanates from real estate, bad real estate loans and by banks and so forth. We're really not at that point. Do you feel in this cycle? I mean, the real estate market is, while housing prices have appreciated nationally, it's very local, obviously, and there are places where real estate market is still at or below where it was prior to the financial crisis. So do you feel that the real estate market is anywhere near a point at which it would cause problems in the economy or strains with the banks? The banks seem to be still reluctant lenders.
From my point of view, I don't think that's the danger zone. You're right. That's not that's not going to be one of the pressure points, an impetus for a new downturn. It won't be the real estate prices.
So just to go back to your first question quickly, I think, and to fulfill your expectations that we disagree with each other more frequently than we agree. The modeling on the long bond is simplistically correct, in our view, but we do have to keep in mind a couple things. Number one, the later you are in the cycle, the more inflation expectations begin to reverse in the longer term. So the inflation expectations begin to pick up the fact that the Fed is closer to being at sort of that neutral point and then the terminal rate, and that longer term inflation expectation as it begins to decline begins to factor into the valuation of the 10-year as well. The other feature is that the 10-year typically only discounts about 70% of the tightening cycle in anticipation that tightening cycle will end once you get past the midpoint. So if you kind of include those two factors in the valuation of the 10-year, maybe it shouldn't be 4%, maybe something closer to, say, 3% or 3.25%. And if that's in fact the case, it's not so far out of the realm of possibility that we're probably at an attractive point to buy the 10-year, say, over the next 6 months as we get closer. One or two more Fed hikes, we could be there. So that would be a bit of a perspective on being too aggressive in terms of the traditional way of measuring fair valuation in the 10-year. In the case of property, we tend to agree with Guy that what you want to watch for are the costs associated with financing property as they continue to increase, where the pressure points begin to build. So, somewhat analogous to our view on investment grade and high yield debt, that the environment will deteriorate, but probably at a very slow pace, and to deteriorate to the point where it creates a quote-unquote crisis does seem pretty far off for the time being.
We tend to look at overconfidence of three actors, central banks. They've been very timid and very shy to bring rates off the bottom. It's not just the Fed, they all matter. Overconfidence of investors. And we, when we look at things, people are above their intermediate term targets in real estate, growth assets, but their intermediate targets are substantially less than they were 10 or 20 years ago as a result of the crisis. And overconfidence of companies, and they're just moving up to the starting gate to express. And one way to express overconfidence is in real estate, but there are many. And where the overconfidence kills you changes a little bit each cycle. Sometimes it's real estate, sometimes it's someplace else. But we think of the three actors, they've been underconfident for a very long time. They're moving sort of towards a more neutral position. And we're pretty far away from expressions of overconfidence, we would say, in real estate. Where you've seen it, you have Chinese coming in from overseas and paying up for the Waldorf Astoria. But we don't think that's going to sort of end our cycle if they lose money on such purchases.
Could I ask you very quickly for your outlook on the dollar versus developed and emerging currencies? Not 6-month view, but perhaps a little longer term.
Well, maybe I could go. The dollar's actually been, the currencies has actually been very tricky for a lot of us because we used to look at relative interest rates and relative growth gaps. And in an era of extraordinary monetary policy, that has sort of overshadowed everything else. But in that sense, the Fed is the first one to start taking it back, and we did have, a dollar go way up on the taper talk, and it's retraced half of that. But the other two actors that really did swell their balance sheets, the ECB and the BOJ, haven't begun the taking it back stage yet. And as they get closer to that, their currencies will clearly strengthen versus the dollar. We think the emerging market currencies at the moment are just replaying a movie they've seen before. Central banks start talking about this, and when the Fed raises rates, people are used to just running into the dollar, waiting until dead bodies float to the surface, seeing how things clear, and they're looking in the emerging markets for the dead bodies to float to the surface. So there's been sort of a fear move, but we don't think it will be a fundamentally justified move. Emerging market currencies at the moment are probably a little weaker than they should be. Eventually, the ECB and the euro and the yen will rise vis-a-vis the dollar when they withdraw this massive monetary accommodation.
So
Different opinions?
Well, we would just point to the more recent rally in the dollar as having coincided primarily with the increased expectation for Fed tightening the better data out of the U.S. Q1 into Q2, and the weakness in Europe primarily. So in terms of the DM currencies, we think that's valid and it's appropriate response. When we look at the dollar on a real effective exchange rate basis, it doesn't look overvalued. It looks pretty much where it should be in terms of relative valuation. And the euro around, say, 115, I think it's probably 116 today, is basically fair value in our work as well. So the expectation on the DM side is we've had the weakness in the dollar, the rebound, and now probably the currency stay stable for the foreseeable future, just based on the scenario that was laid out. EM's a little bit more interesting to us because EM has not come into this cycle with the traditional excesses. You have current account surpluses in most EM countries, and you have relatively low inflation rates relative to where they should be in this cycle and where they've been historically. And so we do see a number of EM currencies on what we characterized as this latest tantrum as creating interesting value, both from the standpoint of rear value and also carry. So that's an area where we're positioned tactically in a number of currencies to try to capture that differential in return.
And maybe disappointing you that I'm far too much in agreement with the colleagues here. We analyze the relative value of currencies on a lot of different models, and we can't come up with the exception of the Swiss franc, we can't come up with any developed market currency that's more than about 5% over or undervalued.
Yeah, agreed.
And you end up with some implications of political risk, driving down the euro or the sterling, but there's really just not much in it. Emerging market currencies, I don't think there's any real valuation case there either. It's just that they're mildly undervalued and massively carry positive. So whether you want to be in emerging market currencies or you want to be in emerging market debt, 80% of the return of an emerging market debt portfolio will come from the currency carry. So we think that's a great place to be. You're going to suffer the volatility of the dollar appreciating a bit, and it hits your currency portfolio, the EM portfolio, but that's probably the right position.
Mike, I think I heard you say that active, not passive, is now the way to go. Our fund and many pension funds have been focused on trying to reduce fees and moving more towards passive. And so could you say a little bit more about your point about active versus passive?
Sure. Well, I'm going to approach it backwards, that in our portfolios where we do invest across privates as well as we think that they're actually easier in a way because you can observe supply and demand to get in. And you earn illiquidity premiums not for being in private assets. You earn illiquidity premiums for doing what no one else is willing to do. 2010, 11, 12, very few people were willing to go into private assets. So it's a very good time to get into those vintages. Today, we have a speaker after who knows a lot more about the topic than we do, but we see a stampede into private assets. And you don't earn illiquidity premiums for participating in a stampede. So there's always going to be, vintage is less important than which manager and which fund you're with. That'll always be the most important thing. But at the moment, we would use our total expense ratio towards active equity and be a little bit more frugal in committing vintage cash flows to many of the private markets now, because they're not priced with liquidity premiums in mind, and some of the asset classes are really in danger of disruption. A lot of the bigger funds are having enormous trouble deploying all the capital they're raising. How discerning can they be about future-proofing each one of those investments? So there's two ways to manage down, the TER, less active within the listed space or less privates. And we're not saying structurally less privates, but just in terms of commitments, maybe it's a time to taper it a little bit and be a little bit more discerning.
If I could just address it very quickly, as someone representing a purely active house, it's almost heresy, but I'm going to say passive management is a great idea, and it ought to be used a lot in those asset classes where you can achieve a passive exposure. And it's the exposure that I'm always really worried about when people say, well, I just want to do it passively. I want technology. I'm going to buy the NASDAQ because I'm just going to take a passive investment in the NASDAQ, which, again, in theory is a great idea. But if you dig just one level down, you'll realize that you're not saying you want a passive investment in technology if you bought the NASDAQ 100. You're saying, I want almost 20% of my money in Apple. And maybe you do. But if you don't, or if you don't know, then I think you have to take a different view of what passive means. So the issue of cost pressures in our industry and what we pay to be invested, I think is a really big issue. We have to talk about the regulatory environment. We have to talk about transactions costs. We have to talk about the cost of research. I think that's a very rational conversation. The best way to address these costs, though, is very rarely through the difference between active and passive management. Passive management is a really good idea for those assets where you can get a passive exposure.
Yeah, and passive investing always guarantees a loss versus the index, remember, because you have not only fees, but you have the tracking issue. And in the more inefficient asset classes where you're making those passive investments, the greater that risk is that the drag versus the index increases over time. So to the points that both of you made, budgeting that passive exposure to the more efficient asset classes where alpha generation tends to be more compressed by active managers, and focusing the active budget on the portfolio managers where the dispersion is greater among managers where you have a chance to actually capture superior alpha makes the most sense to us. And so obviously international versus domestic, but even within domestic, if you're looking at large cap versus small cap gives you much more firepower in our view in terms of active management than large cap. So again, a similar point, but investors typically think that a passive investment is going to guarantee an index return, when in fact there can be a pretty material drag on that index return from your passive investment if returns are, say, in the mid-single digits year in and year out or less. It's material.
Kind of in a similar conversation, Mike, and then y'all can comment too. You mentioned being liquid and something to the effect of not focusing on passive investments in order to afford private investments. So can you talk about it? But at the same time, you said we're kind of mid-cycle, and AI and other things are kind of just taking off. It kind of seems like that might be saying, you know, we've got a good bit further to go. So why did you? I didn't quite get why you said we need to be extremely liquid at this time.
On the margin.
And does that affect
Yes.
the amount of private investments we ought to have?
I think it matters less to real estate or infrastructure, but in private equity and private credit, which actually are the two private areas that we as a firm are a provider of, you do need to make sure, since most of those portfolios are very concentrated in terms of the number of positions, if you enter a business environment where many industries become disrupted, let's just say in the last 10 years you had a lot of department stores in a private equity or private credit portfolio. Sort of the Amazon phenomenon put you at great risk of riding just one or two of those to zero.
Yeah.
Now this is actually spreading, in our view, well beyond Amazon. And people are arming themselves. Interesting factoid, Google, in their March quarter, beat on sales, beat on earnings, the stock went down. Because their guidance was, we have to materially spec up our investment in new capabilities because we have to keep up with Amazon. Google, imagine that, 5 years ago, everyone had to keep up with Google. But in an era when you go through a very technology-intensive period, and you have a lot of change, those are historically associated with accelerating growth and at the same time accelerating bankruptcies and defaults, because disruption means whole industries you never would have suspected all of a sudden come under great pressure, and many of those constituents go out of business. So the point there was, if you're liquid, you can, and it's very hard to spot an industry just before it's disrupted. But you can take a loss and sell on your way down if you're liquid. But if you hold too many of those in your private investments, you could ride them to zero. So we think it's the nature of the beast right now, the environment, that we don't recommend things. We can only share what we're doing in our multi-asset portfolios. We have materially boosted our share of active equities and reduced our share of passive, which was conspicuously high. Our share of passive for much of the stall speed was conspicuously high for an active shop like ours. We thought the environment was not conducive to active for a lot of reasons, and I enumerated them, but it was basically the competitive timeout. When most people are not investing, you don't have a lot of big share shifts. You don't have a lot of disruption to a lot of industries. Now that game is changing, and so winners will win bigger and losers will lose faster and further. And in that environment, we prefer sort of high active share equity managers. Now, the average high active share equity manager isn't going to earn any value, and they're going to have bigger fees than passive. So you have to be very confident in your manager selection. But we're willing to take that risk because the bigger risk in a disruptive environment is being too illiquid where whole industries begin being disrupted.
Thank you.
We have time for a couple more questions.
I'd be interested to know where you think China lies in the investment spectrum. I mean, we all hear, lots of talk about how investable China is and the great potential it has. Yet there are significant problems there. And I'm just wondering if you think that the future growth of China outweighs the problems that they have right now, which are significant. They have problems in their banking system. They have problems in real estate. Government's cracking down on speculative loans. And the one thing that I find very interesting, if it's such a great place to invest, why is so much money, Chinese money, flowing out of China to be invested in the U.S. or other parts of the world, and particularly into the real estate markets here, as you well know. And the government has actually put restrictions on outflows of money out of China. So I'd be interested to know if, in fact, we should be thinking about investing in China, which has 1.3 billion people and has significantly raised, tens of millions of people into a higher economic status. Where do you think, what should we do in terms of, I mean, it's too big to ignore. So do we take a more positive attitude here, or should we be reluctant investors as far as China's concerned?
Maybe I could start. We spent a lot of time in China and have always had a joint venture in China. Kind of, we and our predecessor have been there about 100 years. The money trying to get out has slowed down a lot. They've actually started opening up quotas to allow for more of a two-way flow. But China investors are almost famous or infamous for sort of a one-directional market. Everyone wants to do things in the same direction at the same time. And they really shut down, the ability to go out when they were coming through a sort of turbulent transition. So, while we agree with Mark that at the moment the economy is slowing there, we actually think it's slowing for a good reason. They're deliberately trying to shift the mix, which they've been trying to do for 10 years to get out of such capital-intensive growth that was debt-led, investment-led, because growth wasn't naturally happening elsewhere. Now it is. Now it is happening elsewhere. And so they have the ability to stop sort of jamming credit into the system, to jam capacity into the system in old industries, to jam oversupply on the world of a lot of old. So they've really shifted gears because they can. And it's going to manifest in a slow motion slowdown, but it's a higher quality type of growth. It's much more non-capital intensive consumption services. The number of patents being granted in China is soaring. They're, unfortunately they've stolen a lot of it, but they're also developing a lot of new technology now. There's a lot of very interesting companies. And I think everyone needs to boost their IQ on China because they are going to become a much more material percentage of the stock and bond indices in the years immediately ahead. And so you're going to need to have a perspective. And we think actually investing in China somewhere later this fall is going to be a very good idea. At the moment, they're in a slow motion slowdown, and you won't be rewarded for that.
Go ahead and address the question. Some of the charts that we pulled up on the deck are a bit more tactical. So I think entirely in agreement on the kind of the first question you posed, which is strategically, where does China fit in a portfolio longer term, say 5, 10, 15, 20 years, as the economy gets closer to being, in effect, a developed economy and no longer an emerging economy. Some would argue it's already there. But nevertheless, the need to have the same level of discipline around an exposure to China in a portfolio will be equivalent to the discussions we have today on U.S., Europe, and Japan, and to a certain extent the U.K., which is falling more toward the other side. So to that point, I think it should be a constant focus in terms of its place in the portfolio and the nuance around the benchmark exposure, which will continue to grow, will be the more tactical views on the direction of the economy quarter to quarter, year to year. What's happened now, however, is, in our view, the end of this investment cycle, which has been built on the back of leverage in the economy and has gone through a very traditional industrial, government-led, financial, and now most recently consumer, right? You now have over 60% of homes being bought with mortgages in China today. 5 years ago, that number was 30%. So they've used this last source of leverage to actually continue to keep growth stable in China. And it's caused an environment where debt to GDP is now well over 300% in the Chinese economy. Keep in mind that in the old days, we used to see an EM country get to 130, 140% debt to GDP, and you couldn't go short the stock market fast enough to get ahead of that unwinding of that debt bubble. So at some point, China will have to deleverage more aggressively to establish the platform for future growth that we all see and all want to take advantage of. And we would just argue that the short-term dislocation that will be required to get there is going to have a more material impact on Chinese equities and assets associated with Chinese growth than investors expect. Someone mentioned the Australian economy being in the 24th year of recovery. Well, the Australian economy has benefited completely and coincided entirely with the demand that China's had for raw materials coming out of Australia, primarily iron ore and other metals. So it's there are material knockoff effects around the Pacific Rim and around the world from China being able to deflate this leverage bubble effectively over time and avoid any type of a crisis. Again, mixed on their success rate in doing so. But it's difficult for us to see how the deleveraging of the economy can equate with equity market outperformance in the near term. And that's our biggest concern.
It's probably
But
good.
isn't that, to a degree, that's an index construction problem that is, pretty significant over there, right? I mean, like, if you think about the money that went in, say, to the interstate system here, you can't name a single company that built it, right? But McDonald's is on every exit now, right? But McDonald's in 1950, whatever, was teeny, it was a speck, right? And now it's the majority of our market cap, right? So that's largely,
Yeah, I mean,
and how do you express it, right? And that gets a little bit to the indexing. I mean, what you want to index is the future, so
Yeah.
you got to have a active view of what the future actually
Yeah.
looks like to know what you want to
I'm laughing.
buy today.
I'm laughing
right?
because I was in Beijing on Tuesday, and a major Chinese government investor, I feel like he's sitting right in that chair speaking to me, because his whole point was Americans don't get the consumption wave that China is going through right now, and the rebalancing of the economy between capital intensive and consumption is happening just as it did in most major developed economies over time. And we just don't understand why investors outside of China can't seem to grasp this development. And in a very sort of politically sensitive way, you have to say, well, A, you're doing it with capital controls, which means the capital can't leave the country, so it's almost forced to invest domestically. That sure helps. And secondly, you're doing it on the back of a massive debt burden that the country's going to be faced with going forward that has to be accounted for as well. And now you're placing that burden on the back of consumers. So it's not just the government reserves that will bail out that indebtedness. It will now be required that consumers pay a part of that as well. So you can't be that direct in terms of the pushback, but that would be the near-term concern that we would bring up as a counter argument to the consumption wave, which again is just being built on credit. Consumers don't use cash anymore in China. It's all being done with credit services on your telephone. The telephone has become the currency, and it's not an over-exaggeration. It is everywhere in China. As good as Americans are in terms of managing their credit, imagine the Chinese who've never had the ability to use this type of credit, paying for everything with the phone without any regard to what that balance looks like at the end of every month. So hopefully it works out, but the concern in the near term is that these are excesses that have to be corrected for, which is entirely natural when an economy is exiting developing status and entering developed status.
If you wanted to have in another meeting a China session, we'd love to participate. 'Cause
Well,
the,
yeah, I mean, the big question with China, I mean, I guess if I can I'll throw out a few things. You don't have to answer them all because I know we're short on time, right? But I want to, if I can break them into secular, cyclical, and then what I call tactical questions that kind of came up, right? On just the secular thing, particularly China and the oil, right? Traditionally, the U.S. was the marginal consumer, and our consumer would slow down between a combination of higher rates and higher oil, right? That's what late cycle looks like, right? Because oil is a tax and money goes out, and interest rates, raise the marginal price of consumption, right? When you're doing it on borrowed money, and GDP would slow, right? I mean, that's to a degree that traditional thing. I'm curious of the underlying structure of energy, right? And China moving in that role as marginal consumer on that energy equation, right? Because that's about 50% of the trade deficit, and it's when you have that key commodity that's not internally generated that your economy becomes more susceptible. So really, two questions: are we more resilient, even though we're getting what would traditionally be late cycle behavior because we produce more energy now, relative to our domestic consumption, and how do you monitor that out of China and kind of their role, right? So that's a little bit more of the cyclical part. The secular has to do a little bit with the demographic effects, right? Particularly with like housing, right? I mean, we got a gap here, right? I mean, the baby boomers came through; they don't want houses. This gets to inflation measurement, right? I mean, that's why I'd ask it on a secular, right? Because housing's 42%. Your houses aren't going up in price, right? You're not going to show inflation on the headlines. But if everybody wants health care, right, what they experience is something quite different. And the inflation under QE has been just in financial markets, right? And Kindleberger's very clear, right? When your financial markets and your asset markets aren't attached, you've got a problem, right? And we sort of disconnect them, right? So we put money in the markets, but it's not really out here, but it's not out here because the demographics don't want what's out here right now, right? Old people don't need another house. They got a house, right? So how do you think about that both here and in China? Because they got a demographic issue as well, and I'm curious what your thoughts are. I mean, our problem isn't as bad as Japan, but they had a demographic issue for a long time, and their real estate market didn't really recover, right? So there's a demographic effect in there. Hopefully ours comes along with the millennials, but they're still 10 years out from home buying age.
I don't think you can compare the Japanese experience with the U.S. just because of the closed economy. You don't have an influx of immigrants. You don't have the same kind of dynamic at the borders, quite frankly. I think we ignore supply and demand too much, and I'm glad you brought it up. Do people want the houses that are being built? I think they do. I don't think we have anything like the huge dislocation between financial assets and real assets. But there is a dislocation. I think it's widened, and that's why you get these sort of violent corrections in financial assets every now and again. The next violent correction will be both, however, stocks and bonds, and I think that's the new environment that we're not used to. So if you get that correction in bonds as well, you might have a correction in real asset prices. And I think if we think about the vulnerabilities in all over the place, I'm not sure that we're, in the United States, more robust generally than China is, because we're all subject to this over leverage. It just appears in different places in the economy.
And I guess
generally.
that's the part of the tactical question I didn't ask, but one of you, I think, said it most clearly, has to do with carry trades, right? I mean, long-term capital, carry trades were very concentrated, kind of unwound. Now we have a bunch of carry trades, I mean, because that's what the central banks encouraged. But are the leveraged players, or are we just going to kind of see what I call mini nightmares, right? The volatility index, right now it's in the currency carry trades, right? It's like the market's sort of unwinding positive carry trades kind of one at a time. But do you have any sense, is there any one group that is probably overexposed, or is it going to be kind of just like little episodic flares as QE goes away, that these carry trades are blowing up kind of one at a time?
The only real systemic one I can think about is investment-grade credit, right? That is, you got to remember how big a market that is and how truly illiquid it is. Its capacity is big, its liquidity is low. You don't trade investment-grade credit like you trade equities, or like you trade treasuries, or like you trade sovereign debt. It's name by name, and it's actually very slow-moving. So, you know, the exit door is going to become a pinhole when you get that unwinding of the carry trade. It's going to feel very bad for a very short period of time. That's the only place, though, where I see this massive imbalance that shakes me up a little bit.
Yeah, so is
I'd
there
argue that-
anybody who owns that trade in high leverage, right? Because one thing, if that's pretty dispersed through the marketplace and people largely are unlevered, like retail investors in a mutual fund aren't levered players, so you can blow that trade out and it hurts, but it doesn't, it's not systemic, right? Unless you have that concentration risk.
Well,
Someone
but-
owns that risk in concentration. I
To
guess
Guy's
is my
point, the
question.
size makes it
Yeah.
systemic. So
Yeah.
even, you know, think about what we saw in high yield when energy backed up dramatically, and all of a sudden you had 23% of the index impaired. Everyone owned, I mean, high yield was massively overowned, spreads were at record tights going into that cycle. And while it didn't cause a systematic crisis, it did create massive pressure on the pension fund community, a lot of other kind of critical areas of the economy that have not come back, right? So to Guy's point, we would agree that it may not be the crisis that's associated with the leverage that becomes the impairing factor. It may just be the size of the investment that gets marked down quickly that creates sort of that short-term slow burn that creates a crisis ultimately. On the other side, in terms of whether it has been leverage, it's somewhat interesting to take in mind. We've had, you know, the Turkish lira, the Argentine peso. We've had the Brazilian real. We've had some major surprise events roiling EMFX markets that in the past would be enough to sort of create that tipping point if the leverage was there. And it's interesting to note, and I didn't read the paper today, but it's interesting to note we haven't had any systemic crises that have resulted from those events up to this point. Even the volatility spike that we saw earlier in the cycle didn't create that event either. So in a way, it's almost emblematic of the fact that perhaps there are greater degrees of control on that leverage in this environment currently due to the more cautious positioning that investors have taken coming out of the financial crisis. But the size of these concentrations and investments in very illiquid markets concerns us as well.
Just as we get going, I hate to do this to us, but we do need to shift gears, and we'll please know how appreciative we are that you made the time to come here on Friday. I hope that you'll be spending the weekend in Charleston and you know, supporting our local economy. However, we do need to shift gears now in order that I don't make myself a liar by failing to get our next speakers delivered back to New York safely for the weekend. So, but thank you all very much. Appreciate it. All right. Well, Kathleen is getting us back up and running. I want to go ahead and keep things rolling. I'm very delighted that today we have with us Barry Blattman, who is Vice Chairman of Brookfield Asset Management. Brookfield has very nearly $300 billion of assets under management, largely private markets assets. Hopefully nothing that was said is offensive to you. We have over time developed a very meaningful relationship with Brookfield. Over the years, we have committed slightly more than $500 million to strategies managed by the firm. Aside from having a very talented and deep team of investment professionals, one thing that we find very unique about Brookfield and the way they approach their business is they invest a very considerable amount of the firm's own capital alongside investors like us. To wit, in the last private equity fund that they raised, they were fully 25% of the fund's capital. That's true alignment, and it's something that, it's a business model that frankly we would like to see proliferate beyond Brookfield. So let me hand it over to Barry, who's going to walk us through the private markets, which their firm is uniquely able to do. So we are getting close to having that up and running. So we can. We can. That is tremendous risk management, Barry.
We hear a story, and if I trick, right, they don't see that as a problem because that's I'm being cunning and I'm smart. Who are you?
Yeah, that's what we all been trying to figure out our whole lives.
It's not okay to screw a Chinese, screw a foreigner. I was in Hong Kong.
Want to resend right now?
My first reaction was, oh, trust their ass. They tried to fuck me.
You know, while yeah, we have the books, and while we're working on the materials, I just thought following that last presentation, which was very impressive to me, and this is an impressive group. You should know that I started my career at Salomon Brothers in the mid-'80s. I helped to create the mortgage-backed securities market, which I sometimes call the weapons of mass destruction that caused the financial crisis. I have an economics degree from Michigan, and I have an MBA from NYU, so I feel like I have some friends in the room that you sort of know where I came from. And I would just say that, you know, while we move here into a private market conversation and, you know, thinking about the conversation that we just had, you know, what happened in the public markets in my history on Wall Street, I was interviewed for When Genius Fails. I met a number of different groups that, you know, were the smartest that you'd ever meet. And when I decided to move into the type of business that I'm going to describe in terms of related to private markets, I found it to just be a lot easier in terms of making money over the long term. So this is a conversation about a number of different, you know, private market strategies. And let me just first set the table in terms of where I come from, in terms of you know, the world that how we have a view on this world. And I'll page through some of the materials in the book. So first of all, as was mentioned by Jeff, and thank you, Jeff and Michael, for having me here. We're a leading global investor and operator of real assets. On page, on slide 4, just to give you a footprint of what that means, as was mentioned, we have $285 billion of assets under management, 80,000 employees, 750 investment professionals. You can see from the picture of the globe, the markets that we're in, this is a very large operation. And on the next page, you will see that our assets are split between three primary areas: real estate, infrastructure, and private equity. You can see the size there. You can see the asset classes that we can speak to and are our areas of focus. What we're going to talk about today in terms of the different private markets on the next page. With regard to private equity, there are a number of statistics that point to lots of capital. It was mentioned before, money running into private markets. There is the fact of long-run outperformance over public equities. And here we go. And I'm going to talk about all those statistics, but also just how we see the world. With regard to private credit, I'm going to spend some time on that. Real estate, clearly an area that I'm looking forward to following up on some of the conversation that happened in the last panel. And with regard to infrastructure, knowing that your commitment that was made to Macquarie is probably top of mind. We have obviously significant views in that regard. But first of all, just in terms of the highlights of private markets, this is a Hamilton Lane chart, and you can see that all private markets, including PE, private credit, private real asset strategies, have returned 12.6% annually over the last 15 years. Over the same time, public equities returned a lower number, and I would say at Brookfield, we have a large amount of public market activities alongside what I'm going to describe. So, we have reasons to view each as having a proper place in portfolios. But for us, our focus on private markets is what really drives our successful performance over a number of years. And I just want to use this slide to describe where that comes from. So our company has been in existence since the late 1800s. We have owned large industrial complexes around the world. One example would be integrated pulp and paper type companies. I just throw some photos up here of trees, a river, a box cutting plant. And those are very cyclical businesses. You could own shares in that type of company. You could own debt in rated debt in those types of companies, but they are incredibly cyclical. As an owner and operator of those types of businesses back in the 90s, we decided this makes no sense. You can't sleep at night with this kind of operation. We should look at what this is really made up of. And what we did was we restructured companies like this. We pulled the timber out and decided it should be sold to whatever buyer around the world would pay the most for it. It's an asset class on its own. We should take the hydropower generation that runs the plant at the property and enter into a long-term contract with the utility and turn that into something that generates high-quality cash flows over a long period of time. And the box cutting plant is a private equity situation. You should buy it when it's cheap. You should operate it safely. You should own it through a cycle, and you should sell it after you fix it. And that basically, if I cut through all of what a company like ours does, focusing on private markets, is the bottom line. It's applying the right kind of capital to the right part of the industrial complex and recognize where cyclicality is at play. You can't be a real estate owner like we have been and not have tremendous respect for cyclicality. Our overall complex, as was mentioned, controls about $110 billion of our own permanent capital. For our beneficiaries, all we try to do is to invest in a way that will generate growing cash flow backed by high-quality assets that will appreciate over time. That's what we try to do, and that's what we find is most doable in the private markets, where we can sleep at night. With regard to just some of the statistics about private equity buyout funds, all of the most talked about numbers would be give rise to the kind of conversation that would question where are we in terms of the opportunity. If you look at dry powder, an all-time high. If you look at net IRRs in buyout funds, this chart shows by quartiles and by median for a long time, very strong, declining slightly now, but regardless of where you are, the returns have been quite attractive relative to alternatives. There's a lot of talk about private equity multiples rising, and here you can see both in terms of valuations and in terms of debt levels, we are back to high numbers. And that brings into question, what are the opportunities now in private equity? And then there is the historical performance of private equity, which has been just extremely strong. And over 25 years, the U.S. private equity index has returned 13.4% annually, and to compare that over the same time frame, it has just been a consistent performer over all other public options. So, how do you then combine this history with where we are today? And I just think that in order to have the right conversation about it, you can't look at the overall statistics as an indicator of what the true opportunity is. The fact is that when you look at private equity, you look at buyout, there's many different types of strategies. There are those groups that focus on growth. There are those groups that focus on value. We particularly focus on value. When we look at value, there's a number of different areas that are what we would look at. As I mentioned before, in these broad industrial complexes, if an investor understands how the entire industry is operating, how it's working together, in our case, we own all the rail lines in Australia that iron ore moves on from the mining companies. It gives us tremendous insight into what's happening with the steel economy. In a real estate business that focuses on logistics-related real estate, it gives us tremendous insight into what's happening at the operating level on those businesses that focus on distribution. Owning a mall business, it gives us tremendous insight into what's truly happening in retail. This is the kind of conversation that comes out of private equity investors. It's much more about understanding the underlying industry. It's much less about just true multiples. Companies are being sold every day by bankers who are trying to find the buyer who will access the highest amount of leverage to pay the highest price. A lot of the private equity firms that are going to generate the highest returns are not going to be looking at those kinds of situations as the way to, with respect for cyclicality, make the kind of money that we look to make. So I just think that the overall statistics are very misleading. We, using an example, and I referenced steel, are enjoying the kind of success on one transaction that's indicative, where we acquired a U.S.-based company called GraphTech that makes graphite electrodes, which are critical in the process of converting scrap into steel through electric arc furnaces. The graphite electrodes are a tiny cost of the process of that transformation. And we recognized that the demand was going to so far outpace the supply that if we could get control of that company, we could go to the buyers and we could say, what is the right price? And this is what we did. We took over the company. We ran an auction to find out what the clearing price was for the material. It was significantly higher than what the company had been charging. We then went to that buyer base and said, in order for you to secure this part of your process, we want long-term contracts, which they agreed to. We totally changed the nature of the business. And we ended up now having done an IPO to exit a part of the transaction at a 7x multiple. And based on where the company is trading now, it's at a 9x multiple. But when we bought the company, it had multiple in terms of the valuation that was really infinite because it basically was generating no income. And that would have been a very misleading kind of statistic. So I think that finding value is something that private equity firms do. They're deep into the understanding of the industry, and we are quite excited about the opportunity in private equity now because there is a lot of dislocation. There's a number of large U.S. companies. If you look at, just using an example, like a GE that's selling off businesses, there's always distress that one can take advantage of. And if you are the most strategic kind of buyer, you can do it. And then I would also just add, in terms of dynamics in the market, the amount of public companies trading. People talk about the Wilshire 5000. It used to be 7,500 companies. Now it's 3,600 companies. There's just a lot less public companies because in private hands, the ability to grow a company, take advantage of a plan is so much more efficient. ability to grow in terms of capital and not relying on the public markets, but instead relying on the capital that's in your control. Obviously, not having the cost of a public company. It just allows for creating value, doing it in a way that is more efficient, and providing a long-term capital solution. So, bottom line is, all of the money that's out there, I'm sure that some of it is going to be invested irresponsibly. Some of it is going to take advantage of credit that is too loose. But I know from our perspective, with the right kind of discipline, the opportunity continues to be very attractive, and we think will outpace alternatives comfortably. And I will go through each of these asset classes, and then we can talk more. But this is connected. So private credit, in terms of dry powder, again, another chart showing lots of capital. Private debt funds have grown significantly. We have seen a number of state pensions who hadn't invested in private credit before looking for direction in terms of how to benchmark to make it easier to digest in their system. We have seen insurance companies who are heavily rewarded for debt in their portfolio as compared to equity, and significant amounts of capital moving into insurance complexes because of the annuitization of corporate pensions, alternative asset managers running insurance portfolios like Apollo with Athene, or what others are doing, including ourselves to some extent. But it's all creating significant amount of capital coming into private debt funds. With regard to the opportunity, this chart shows basically through the grayed out area at the bottom that the spreads continue to be attractive, and that's versus high yield bonds. So there's a reason why the money continues to come in. Obviously, in an environment where there is concern broadly about where the companies that these financings are supporting might be high, being in the debt gives a level of comfort in terms of the exposure to the underlying value. The loan market, you can see in this chart, is catching up to bonds. Interest in floating rate debt is very high, and no doubt this growth has resulted in decline in credit quality. Investment vehicles like BDCs, which are publicly traded portfolios of these types of loans, are probably, because they're set with having to invest in this market, or allowing for a decline in credit quality. And I think that when we look at cyclicality and what drives it, and clearly financing real estate is one part of it, but financing these companies is another, and this has to be a place to have concern. And sometimes, we ask ourselves, when you look at capital structures, and you say, where's the smart money and where's the money that needs to be more thoughtfully considered? Maybe this is the part that isn't necessarily getting the right risk reward, but it's attracting a lot of capital. Leveraged loan spreads are coming down. You can see the spike back in 2014, 2015, which was tied to the swift drop in oil prices and its impact on energy companies. But again, a combination of overall statistics that are reasons to watch closely and be careful. But from our perspective, when we think about private credit, there is reason to isolate opportunities that are very attractive. For example, in financings of real assets, especially at a part of the cycle like this, we think that being in the mezzanine part of an infrastructure and real estate loan is very attractive. You can see from this chart the different components of risk that can be taken in that regard. But financing stable assets and transitional assets at a mezzanine level, so say 60 to 80% loan to value, especially when you do it with the skills of an owner, is a really attractive part of the capital structure. And we've been doing real estate mezzanine finance since the early 2000s and have generated returns that are far in excess than what we would have made in core plus and really value add. Because whenever an underlying asset borrower defaulted, we could come in and take over the asset, run it as an owner, and preserve our capital and sometimes make a multiple of capital. So no doubt in this part of the cycle, we think that valuations are concerning, generically speaking, not on a case-by-case basis, but generically, and being in the mezzanine is very attractive. So we think that real estate finance with the right kind of lenders, infrastructure finance with the right kind of lenders is very attractive.
Barry, can I ask, are those yields consistent, in your opinion, whether you're looking at real estate or infrastructure, or is that these yields are real estate oriented?
It's hard to get exactly those returns in infrastructure, given where underlying infrastructure is priced. But I would say that as we look at the evolution of the infrastructure market and the growing universe of investable assets, and the fact that the intercreditor arrangements between senior lending and mezzanine lending in infrastructure is a blank sheet of paper still, whereas in real estate, it has 30 years of precedent, that it's going to evolve, where infrastructure will start to create a similar opportunity to real estate. And also, the more that the financial institutions start to have large portfolios of infrastructure debt on their books, that is probably going to be at some point underwritten inappropriately, there will be great opportunity to come in and do transactions that will be helpful in terms of freeing up capital and solving rating agency concerns on infrastructure. So this is a little bit aspirational with regard to infrastructure, but we think it's going to be a tremendous market.
Thank you.
So again, on a quick summary then on private credit, it has emerged as an attractive asset class amongst institutional investors. We see capital flowing in from all corners of the world of investing. Like I said, U.S. pensions, sovereigns, insurance companies, very large players, and we're even seeing now growing product development into the retail investor base, things like interval funds and other ideas. And I think that maybe most importantly, as it relates to both real estate finance and corporate finance, we think that the movement of capital into the insurance company portfolios is really important. The question before about real estate finance driving a cycle, in insurance companies, commercial mortgage product gets designated with a whole different rating for risk-based capital rules than any other asset class. So there's NAIC 1, 2, 3, 4, 5, 6 for most asset classes. For real estate, it's CM 1, 2, and 3. And insurance companies are really rewarded for putting on more commercial mortgage debt, which is an important aspect of that market to watch.
Barry, could you very quickly explain the concept of interval funds?
Yeah, so interval funds are basically for retail investors taking a pool of illiquid investments and providing it into what generally had been a market that would think more about liquidity, but here they take less liquidity, and it has structural features that relate to that longer kind of hold period. Okay, real estate. Again, a dry powder chart. We're in a period of lots of capital, and you can see here that closed-end private real estate funds are, again, topping the charts relative to history. Net IRRs in closed-end real estate funds, you can see a significant differentiation between the top quartile and the bottom quartile. And obviously, you can see the what happened, going into the financial crisis, and the differential there. This chart shows the returns on public real estate versus private real estate. The top line, real estate index, represents private fund IRRs. The lines below it, except for the last line, the NCREIF Property Index, are all public comps. The reason that the private performance over 10 years would have been worse was because a lot of the closed-end real estate funds have been large users of leverage. That's not something that we ourselves are a believer in, but the public market is typically going to have it self-financed because a lot of its financing is done on an unsecured, rated investment-grade basis. Less exposure to changes in or to disruption in the credit markets, but the funds got hit hard. And then lastly, in terms of another, highlight of what's going on in the underlying markets would be this march to lower cap rates. And this chart relates to the cap rates that are used to calculate the net asset values of the public real estate companies. And as you're probably aware, in this market, the public real estate companies are generally trading at 20 to 30% discounts to these net asset values, which I would say is a combination of the market's reaction to the view of what's happening with interest rates, number one, and number two, a rotation out of these types of investments into more growth-type, exciting stories, and real estate is not in favor, although from a capital flow perspective, I would say that we're starting to see significant capital coming into the public REIT strategies in a response to that. And this is the chart showing that the premium or discount to NAV amongst the REITs. But from our perspective, when you think about the private opportunity in real estate, there's a lot of ways to find value. I guess number one, there's always undermanaged assets. When you have a platform of the type that an owner such as us has, these things become known. There's properties that are across the street from other properties that a company like ours would own, and we know that it can be done better. There's significant discounts, as I talked about, in the REIT universe, where we're known to be right now in the market to acquire the shares of the giant mall company, General Growth Properties, that we don't already own in a take-private transaction. This is a $15 billion transaction. I mentioned that because, number one, these companies trade at discounts. Number two, retail is significantly misunderstood. There's opportunities globally in places like India, Brazil. There's questions about UK real estate because of Brexit. Sort of a sweet spot in terms of the opportunity in the types of things that we do, because the opportunity to exit to groups that would pay significant prices for assets is high, but at the same time, there's a lot of situations that are there for us to buy at discounts. There's generational rotationship of leadership at a number of the real estate companies. If you think about it, they came into play when REITs helped to save them from financial crisis in the 90s. The people that run these companies, a lot of them are family-owned that turned institutional, but now there is generational change that gives rise to opportunities. And then there's just always the ability to recapitalize inefficiently financed companies. So, we're in the process now, as is known publicly, of raising another opportunistic global real estate fund. We couldn't be more excited about the things that it's going to find. And then the final category, just doing this quick march through private assets, is infrastructure. And I would say that when I mentioned before the map of Brookfield's holdings, real estate was significantly higher than infrastructure, but our crystal ball would say that over time, infrastructure will exceed real estate because the scale of opportunities that's going to be created around the world is massive for lots of reasons. And from a public policy perspective, when the question is asked, where is all of this infrastructure spend going to come from? When one looks at the reallocation of institutional portfolios from low-yielding fixed income and highly priced passive equity strategies to the benefits of high-quality, long-life cash flow infrastructure, there's a lot of capital that could come into the system. And when one looks at how insurance companies are regulated, I mentioned before the risk-based capital rules for debt, for highly structured finance, for structured engineering products that get high ratings. I would say that if insurance regulators gave credit to the quality of infrastructure assets and rewarded insurance companies with lower risk-based capital requirements for those, which would be good public policy and good for the insurance companies. There's a tremendous amount of capital that would get deployed out of insurance company portfolios that doesn't have to come from government pockets. But the bottom line is that governments following the Australian model in the U.S. will be well served to sell off their high-quality cash flow generating assets and use it to finance other infrastructure. And we just think that it's inevitable. There's so much capital sitting in places that wants to be deployed into these kinds of assets, and there's such a need for it. Not only in government hands, but one of the businesses that we do is shared heating and chilling facilities called District Energy. And those types of assets that are owned by that business are, for example, at major university systems, typically thought of as facilities. But when those university systems are looked at by the rating agencies in terms of how they're going to cover the cost of building out their healthcare networks, and they can't keep borrowing and borrowing to do so, they can create very efficient new capital by selling off facilities of that type. That's infrastructure. That's infrastructure hiding in plain sight. But then around the world, there's also infrastructure, for example, transactions that we've done over the last couple of years. When Brazil was in crisis and Petrobras was, it was asked how would Petrobras finance what they needed to do. They sold a large part of the country's natural gas distribution system, which we acquired. In Colombia, they auctioned off this country's power generation system, which we acquired. In India, as they are trying to build out their economy, which needs to be connected with toll roads and other infrastructure, there's a tremendous opportunity to buy critical infrastructure, and this translates into other opportunities. The publicly traded toll road companies right now, because of the displacement in MLPs, are trading at 5 times cash flow. They should be trading at 10 times cash flow. So infrastructure is an asset class that is growing. It's getting more complicated in terms of how it's financed. It's going to create tremendous opportunity, and it's dramatically needed in terms of financing governments and other institutions that are capital constrained while there's a lot of capital there. There's also the fact that corporations don't want to cannibalize their borrowing. Otherwise, corporations that have infrastructure at the core of their portfolios, and they are separating those assets and financing them to owners on a one-off basis. So huge opportunity. Along these lines, then, looking at different asset classes, you can see the ones that we focus on. We think that infrastructure as an opportunity is best sort of packaged in the way that I described. It's not private equity, although there are situations where infrastructure opportunities emerge that can generate private equity type returns. But it's stable assets, it's core plus, value add, using real estate terminology. In infrastructure, as you know, supercore is a term that's used, and supercore is a good word for what this infrastructure really is. Like Macquarie, we are very involved in those types of investments. This is a chart that we had seen that StepStone had put together in 2017, basically showing all of the different infrastructure entities. And it's a little stale because some aren't on the list, but it is interesting in terms of, to the point I was saying before, if you look at the x-axis, looking at income to balance to growth, and then firm experience, and each of these bubbles is based on the size of the different programs. You'll see us sort of in the middle of the page at the top, and that's where we like to be. But there are a lot of players. There are a lot of different strategies, and I would say that from a private markets perspective, going back to where I started in terms of a business businesses that are owners and operators, our view is that infrastructure should be owned in a heavily equitized way. It should be owned in a way where the current cities and municipalities that are going to separate themselves from it can trust that the owner is going to be well capitalized, can trust that the owner is going to have more money to grow the system if that's part of the plan, and that it needs to have a cost of capital that sort of fits in exactly with what institutional investors around the world want to earn. we would be much less enthusiastic about infrastructure public policy that is focused on high leverage, where the pension funds end up seeing the opportunity being more to own low-yielding debt as opposed to better returning share of GDP-related equity. And, that's something that we are pushing hard for in terms of how this infrastructure opportunity evolves. And, in all of these asset classes, I'd say that, that would be my message. I'd also just say that, when you talk to a private market participant as opposed to an expert on the public side, for us, it's just a lot more about understanding the operations, the business, finding value, connecting dots. In our ports business, we own the port in LA, in Long Beach, which is an entirely automated, heavy machinery type of facility that hardly any human touches a container as it moves from a ship to a rail car to a truck to customs. Used to be thousands of dock workers. And unions. And we deal with the Global Maritime Dock Workers Union because we own similar assets in Australia. And the unions are, aligned in terms of dealing with this tremendous change that's coming. And we try to be, in a balanced way, representing the needs of all of our constituents, including the challenges that are faced by those unions who many times, are investing money with us. So for us, there's a circle that gets completed. But the fact is that, we see the implication of that. We see in our logistics-related real estate how much of the facilities are being built with similar technology in mind. We see in our office buildings changing needs of our tenants because much of their back office is being replaced by technology. We see, as I mentioned, the movement of iron ore on our tracks to our ports and have a sense of what's happening in the overall steel economy. It gives us a view that is very different than what's a 10-year treasury going to be in 6 months. It's much more of what is the overall global economy showing us? What are our counterparties showing us when they enter into a 20-year lease in London, faced with their own questions about what Brexit means? When they enter into, a long-term strategy outside of Reno because of things that the Nevada government is doing to be helpful to business. I could go on and on in terms of the information that comes into an organization that focuses on private markets, on businesses, on operating them, that is a very different conversation than what happens on the public side. And not having to be measured on what happens in a month, in 6 months, in a year is a luxury that when I go to a dinner with investment bankers who invite me to sit with all of the experts that were in these chairs before, I'm amazed at how smart their thinking is. But I look around and I say, thank God I don't have to, my success isn't going to be based on being right on these answers because, when genius fails, like when I was interviewed for that book, this kind of business, in terms of the ability to generate high-quality returns over the long term by knowing how to own and operate businesses, by knowing where to find value, by signing NDAs and getting all the information about the companies, by appreciating the capital flows that are coming all over the world. The Chinese insurance companies, as that opportunity, talking about 1.3 billion people finding themselves in a whole new place, well, they're buying insurance. That money wants to get invested internationally because there's not enough for it to be invested locally. That money's being originated at 20-year cost of capital that's sub 3.5%. When they want to buy a quality building, an urban building in the U.S., they're doing it not based on leverage. They're doing it because they're going to own it forever. And maybe some are responsible and some are irresponsible, but that's real money. And capital flows that are deeply undermining the global economy is another thing that just helps make the kind of investment decisions that on the private side, is something that gives comfort when you're going to own through a cycle And you know you're going to need to survive through a cycle, and you know you want to have the best capitalized assets and portfolio companies through a cycle, because then you're going to take advantage of all the other people that are being irresponsible. And you know, a number of firms like ours have been doing this for a long time. The fact that the performance has been good, it's not only that it's been good in terms of you know, when you compare it to today, because capital, it was easier, but it's been good because, you know, I know but, you know, a lot of us know how to do it well and are quite confident about our ability to do it going forward. Anyhow, I should now, because that's the end of what is some very high-level commentary, but I'm happy to have a conversation.
Question, in this rush for money to be invested in private equity or whatever, we hear about relaxation of lending standards and covenant lights and so forth. Have you relaxed your standards at all?
No. We actually, in our lending activities to industrial and service companies, which is primarily what we focus on in terms of that connection to global industry, we don't like to participate just as one member of a lending group and being in one part, you know, like a third of a part of the capital structure, like a lot of the middle market lenders do. Those groups are smart at what they do, but our view is we want to find those borrowers who look at Brookfield as a partner that would be helpful to them. So we do not.
Does the fact that lenders are starting to relax their lending standards and to do things that led us into some of the problems prior to '08, does that concern you at all in private equity? In other words, does it create an environment where it can create problems within the private equity industry?
Most definitely. I mean, you know, like we've been through this so many times before. Cyclicality is real, and cyclicality happens because leverage drops and then leverage comes back in. We are on a march to more leverage, and for all the reasons I described, there's more money to do it, and that means that some less responsible sponsors get that money, and they're gonna take a flyer on other people's money. So sure, it's there. We're like others, you know, we don't like if we get a call from a banker that's been hired to sell a company and they're offering Staples financing. The bankers know that we're not the best call for that. But we see it happening every day. And some of those companies, some of the buyers are making the decision to take advantage of that leverage and to pay a high price because they have a view on what they can do with the underlying business. And if they're more expert than us, it's hard for us to judge, but there's lots of things that get sold at prices that are well in excess of anything we would pay. But, you know, I would say even at times when there's less leverage in the system, it's never easy. Like you always feel like the decision you're making, if you're going to be the buyer, is that you're the one paying the most. But what firms like ours try to do is to make it so that we find non-competitive situations where there's a reason why we're able to solve a problem. Firms like ours sometimes will say, look, we don't have to buy 100% of your company. We'll buy 40% of your company. We want to make sure that we can execute on a business plan, and we're going to let you continue to own the upside on your 60%, but let us get in there and do our thing. Let us deliver what a company like ours can, given our network, given our global presence, given our capital. And, so all the firm like ours that puts so much money into the things we do. I mean, Jeff mentioned being, significant in the fund that he described. I mean, we're putting $3 billion, $4 billion into our funds as an LP alongside our partners. For us, it's a lot more about making sure we generate high returns, preserving our capital, and if things don't go right, we're not going to think about walking away from it. So we're really careful about the things that we do, but we see a lot going on around us that is cyclical. Yes.
Two things. I've asked this of several folks before. I'd be interested to get your take on it. Number one, maybe not so much anymore, but in the past, the trustworthiness of the information that comes from and about China. We'll get your take on that. And number two, I've been underwhelmed with the coverage of the change in effect that will be nice and call it the migration into Northern Europe that has taken place over the past 2, 3, 4 years. what kind of effect have you seen, and what does that do to your outlook? So if you comment on the China thing, and that, I'd love to hear what you have to say.
Yeah, so with regard to China, we have we take slow steps to get into markets, and we think that in the next 50 years we need to be ready to play a much larger role in terms of investing in China. But so far it's been slow. So our seeking of information out of China has been a combination of making sure that we're in touch with government officials to hear about what they're doing in terms of reducing steel capacity, and when they say to us, one thing you can know about when you speak to the government of China, we do what we say we're going to do. And so when we come back and we have conversations again, we're talking about whether, in terms of steel capacity, they actually have been taking it out the way they say they have, and they've been pretty good about that. When it comes to information about companies, I'd say that our view of that is there's risk there, and we hope that that risk will cause opportunities to spit out of the bad things that happen when the information is from public companies wrong. So that if you look at, we have had good relationships with groups like Anbang and HNA in terms of them buying assets from us. But now that they're under pressure, firms like ours, see great opportunity to help them with their issues by being a buyer of assets. So I would say, there's reason to be cautious as an investor in those kinds of companies. There's reasons to be opportunistic because of the fact that not all of those things have really found their place in terms of what happens with reporting and reporting standards. With regard to migration, I think that, the best conversation about the risk in the world is one that takes into account the scale of migration that's happened and what kind of issue it's caused, compared to the scale of migration out of Africa that could happen that would dwarf what we've seen so far and what that could cause. So I think that that's a critical issue that you can only sort of look and see and make sure that you try to be cautious. I'm sorry.
Well, for about the past, 12, 18 months, I've read where probably mainland Europe a better place to deploy capital now than maybe domestically here, because their economy hasn't grown out as much since the crisis as ours has. And I'm wondering if that's a factor and maybe one of the reasons that their results past 18 months, 2 years have been less than what was maybe expected back then.
Yeah.
And
So
to have an effect.
Yeah, look, it causes disruption. It causes again, on specific situations, opportunities to emerge that are as a result of that disruption. As a firm, I wouldn't say that, we talk about opportunities, the opportunity set as being heavily weighted towards Northern Europe, because we see risk in Northern Europe, but we see some complexes that could offer value. For us, the kind of situation that will, in private equity, for example, attract our interest is if a company has manufacturing operations, in some place in the U.S., someplace in Canada, and someplace in Northern Europe, maybe because of the efficiency of one operation versus another, we will find an opportunity to take advantage of bringing, shutting down a factory, or, so ours is, again, more down at the level of where their operational improvements, and Northern Europe, will be interesting to watch in that regard.
Other questions?
Yeah, I've got one, or actually two, and they might be answers might be directly related. One is, I was involved in this commission, not as a commissioner, but around meetings from 11 through 14, and I never remember the word infrastructure ever being mentioned. So now I come back in 17, and it's like it's its own asset class, and I'm just wondering if I missed something, or if this really is emerging for some reason. I notice, you provided a comparison of private equity returns to public equity returns, and private real estate to public, but nothing on infrastructure. Is there a history of infrastructure returns we can rely on and benchmark and all that? It just seems new, and I'd just like you to address that, and then part two, and that this might be related, is you said infrastructure assets under management might grow beyond real estate. And so it seems like it is growing. And why is it growing? And is that necessarily a good thing? Maybe governments maybe they're just too costly. And that's why they're growing. You're trying to find other buyers because the government can't afford them anymore.
Yeah. So look, I think, my perspective on the history of infrastructure, for example, we acquired the Chilean transmission system back in the early 2000s from some Canadian pension funds. We did what I described in terms of pulling hydropower out of industrial complexes and turning it into long-term cash flows. While we were doing that, firms like Macquarie and Babcock and Brown, going back really years before that, were mostly looking at infrastructure transactions in sort of cross-border tax-related from that kind of mindset, because there was lots of opportunity to do those kinds of things. So back in those days, there were investors that wanted to own the tax benefits, and they really drove the equity. But it was not in the mainstream. It was dominated by groups that would take advantage of very high leverage, and as tax rules changed, firms like Macquarie and Babcock started to recognize that those assets would be of interest to institutional investors. They and some others started to package them in vehicles. Many were publicly traded, externally managed vehicles that paid much too much for assets, and there was crisis. The transformational transaction for us in infrastructure was recapitalizing when Babcock and Brown went into bankruptcy, a large pool of assets that had been aggregated into something that was large enough for us to say this is really worth our efforts. And we were able to buy assets that had been acquired by the previous firm at something like 20 times cash flows for less than 10 times cash flows because of that distress. And I would say that then different institutional investors who got into it started to demonstrate to others that this was an asset class that needed to be paid more attention to. We ourselves have had such tremendous success that we've made it known, to our clients, and a number have participated with us, and the scale has gotten huge. So now all of the people in consultants and a number of investors recognize that it truly is a attractive asset class given the challenges that are faced by investment organizations like yourselves because of the quality of the cash flows that are going to be generated, and because it is going to be a real business where things get priced too high and opportunities arise to buy distressed, or things are priced at levels that reflect lower risk, that generate attractive lower returns. The reason it's going to get so large is just like I said before when I pointed out the picture of the integrated timberlands business. These assets are sitting in places that aren't the best owners of them. They're the best users of them, but they're not the best owners of them, and they trap capital. And I think that when we study economics in a capitalistic system, and where money's going to come from, going back, to just how the world works, I don't think that we're yet working under a mindset of where the money really is that could go into these things, that wants to own these things, while the world needs these things. And it's just, the stars are just aligned in so many ways to make it so that the investable universe of infrastructure assets is going to explode. In China's One Belt, One Road policy, if you just think about the intersection of politics and infrastructure, China basically has, with their own money, decided to subsidize the creation of a network of logistics-related infrastructure that brings together all the economies from Asia into Europe. And this is rail, this is airports, And the reason they're doing it is because of political influence that they get out of it. You know, there are countries that look at what's being built by China, and they feel like their economies are going to be transformed because of access that they're going to get to markets that they didn't have before. That's the intersection of politics and infrastructure. In the U.S., you know, when I talk about what we're seeing happening with jobs, I mean, the job numbers are good. The wages, I sort of wonder where they're going to come from. I think that the United States is going to need ultimately to act on infrastructure policy. Doesn't need to do it as much now because, you know, the stimulus from the tax plan is doing a lot. But it's another arrow in our quiver in terms of, you know, jobs and driving economies. And, you know, with a real estate and infrastructure hat on, like urbanization is a theme that is critical. Investors around the world, the Chinese life insurance companies, they want to keep putting money into the best buildings in cities. Cities require more infrastructure. Even like I talked about district energy, you know, when you think about a Legionnaires outbreak in a city because the water and the heating systems isn't being done properly. Well, in private hands, like the pH level of that water is going to be monitored precisely. You know, there's just an inevitability in terms of that there's capital there, there's a major capital need in the world. The assets are going to grow. They're going to grow in North America. They're going to connect North America, probably like One Belt, One Road is doing in Asia into Europe. They're going to connect North America more from north to south. You know, we talked before about China's energy needs. You know, look at the news that has been coming out about an arrangement between Sinopec and Alaska in terms of securing long-term LNG through projects in Alaska that will, through new infrastructure that gets created, facilitate long-term contracts of energy going into China at prices that may be above market, but they secure long-term LNG. There's just a lot of connecting of the dots that gives rise to that prediction. But again, it's all, in the end, for us, you know, it's all about then understanding a global economy and how industry and how disruption, you know, can be observed because of what is getting filtered through our system, because of all of the decisions and all the negotiations that our counterparties are saying, you know, this is worse, I need a deal on this, or I need, you know, I'm growing, I need money. Like it's, again, I'm sticking with the theme. Like all of this leads to a private market reality. Focus on companies, on operations, long term. It's, you know.
I think even the public companies are more aware of it. I mean, you see hotels separating ownership of the hotel from the operations. You see the oil company separating their infrastructure from their, you know, it's just the idea of having to be both the operator and the owner of the asset conceptually is split across every industry.
Yeah, now hotels, you know,
Yeah.
I mean, separating good REIT income and bad REIT income is a reason to give rise to hotels. And then also in a time, you know, where you have inflation, you have, you know, rates going up, like hotels reprice every night. The more hot money public markets, they want that. So there's great demand for owning, you know, having direct exposure to a cash flow stream that's getting repriced every night. Nothing's faster than hotels. So you're right. I'm just saying, you know, but again, it will be an overreaction and then, you know, a change.
Barry, we're 1 minute from me becoming a liar, so.
Okay.
I
Thank you
told
so much
We'd
for-
have you done by noon, but thank you very much for being here. We do very much appreciate your perspective.
My pleasure. Thank you for having me.
Thank you.
All right. Well, that concludes the events of the day, so I don't know if we need to have a motion.
Motion to adjourn?
To
or
adjourn,
do we
or-
just- oh, is there a motion to adjourn? And I take that as a second.
third.
And I kind of take that as an all ayes.
that's all.
Well, so is this your last meeting, Chair?
It is, yeah.
Good job. Good work. Congratulations.
Thank you.
Thank you very much.
Thank you very much. Really appreciate it.